Hello, everybody. Welcome back to another episode of the Market Futures. Thank you, everybody, for being here. I'm sorry I'm late in those last 2 minutes before you go live. Something always happens, but we're here. We're live. Thank you, everyone, for being here. We got a lot to talk about, folks. We are entering into the third week of November for the equity markets, and the past 2 weeks have obviously been pretty choppy, I guess is one word to describe it. We're at basically where we were 2 weeks ago on the S&P 500 at 672. The way we got there over the past couple of weeks was kind of crazy. In pre-markets on Friday, it was just, there were some stocks that were getting back to April Liberation Day levels, and it was just kind of crazy. And then you had the bulls come in at 9:30. Then you had a little bit more bearishness intraday. Then we ended out kind of green, kind of had the same story last week. Obviously, we had a pretty choppy October as well. So the continuation of that chop into November has been a trend. And this week is going to be very important because this week we've got Nvda earnings, which is going to be, just one of the biggest events of the entire year, given we're getting into the end of the year and Nvidia is the most important company in the world. I'm going to put the green or red poll for tomorrow in the chat. Futures are already green. They actually flipped green. I posted a screenshot on Twitter like 4 minutes ago and it was flat. And I was like, oh, okay, futures are flat. That's good enough because we'll talk about crypto. Crypto has been imploding over the weekend. So I was like, you know what? The fact that we have some flat futures, this is what I posted a couple minutes ago. I was like, we can handle this. If futures are going to be flat, that's not that big of a deal. And then literally 3 minutes after I posted, we go green. I don't know what happened. I don't know if there was a headline. I didn't see any crazy headline, but they flipped. Crypto crypto's not green, but it's trying to develop a little bit of a green candle higher. And we'll talk about some of the stuff that could be going on with crypto. But yeah, we got futures that are green, which is really nice to see. So this week is going to be really important because the past 2 weeks have been ugly, just in terms of the choppiness back and forth. And so, this week's going to be important to see, can we start developing a bit of a bottom around that choppiness? Tom Lee has, kind of predicted a couple weeks ago that the first 2 weeks of November would be choppy, and that's kind of what we're getting. And so this is the latter half of November, right before Thanksgiving. We got a bunch of holidays coming up. And based on FundStrat's note this morning, which we're going to take a look at, Bitcoin, right, they're trying to get a little bit of a bounce off 92. It did hit 92,909. Ethereum hit 3,003. Was $3 away from going below 3,000, but did not get to those levels. 3,100 right now on Ethereum. His argument is that he really does believe this end-of-year chase for fund managers is going to take the S&P 5% higher, which would bring us to that 7,000 level. So we'll do some analysis and see if that ends up playing out. But nonetheless, that's going to be one of the most important things that we have to take a look at. On top of that, you got a lot of stuff going on in the, I guess, bifurcation of economy argument that we've been talking about for a long time. There's a lot of different things and data points that I've been looking at over the weekend around this idea of two different economies and the health of the consumer. You had the professor from Ashwath, or from NYU, Ashwath Damodaran. The dude went on the Prof G podcast. His podcast got like 200,000 views. And I think he basically scared the shit out of everybody. It is an hour. I was listening to it on the ride home yesterday in my car, and I was just listening to it as I was driving, and it's just constant bearishness from this guy saying we are absolutely in an AI bubble. It was not a question of if we're in a bubble. It's a question of how aggressive the bubble is and if the bubble is going to pop. Or not if it's going to pop, when it's going to pop, and to what extent it's going to pop. The guy recommended taking some of your money and putting it into collectibles. He even mentioned Pokemon cards. I told Steve about that. Steve couldn't believe it. Not saying that he is investing in Pokemon cards, but he mentioned that's an alternative asset to be curious of, given that AI trade is so overexposed. And again, I just think there's two different perspectives on this. Either you believe that's the case, and as a result, you're kind of more scared of the AI stocks, and 2026 is going to be bad for the NASDAQ, or you think that's not real, and you think that Google trading at 27 times earnings is not a bubble, even if some other parts of the market might feel like they're in a bubble. So we'll explore those arguments, try to do a bit of a research this week on those, or this weekend, and we'll kind of analyze what happened. Elon also gave a keynote with Ron Barron, and he talked about a bunch of different things in the world of AI. Elon and Sundar went back and forth on Twitter, and they said some things that I thought were relatively bullish. We're going to look at that. And then we have a bunch of macro charts that I want to pull up to also kind of show what we've got going on as we prepare for 2026. Aswad did sell a lot of his Nvidia. I mean, technically, he said Nvidia was overvalued back when Nvidia was trading at, I forgot the pre-split price, but it was about a year and a half ago. And I think Nvidia has done like a 3x since then, maybe like a 1.7x roundabout. I got to calculate the numbers, but he's been screaming overvaluation for a while. Obviously, stocks have not necessarily faulted in this kind of overvaluation argument. But I think the sentiment in general is starting to become more of fear. I put out this poll as well that got 9,000 votes on X. And the question was, hey, what do you think for 2026? Bullish, bearish, or flat? 41% of people said bullish, but 27% of people said bearish, and 32% of people say flat. If we were to have a 20% 2025 return, we're at 14% right now, so we got 6% to go. That would be 3 years back to back to back. If we have another 2026 bull run, that would be 4 years in a row of 20% gains, which is not impossible. It's just hard to see. But then again, do we get a bear market in the midst of this prolific bull run? I mean, it happened during that 1998, 1999 time. It ended up recovering until it topped out in 2000. But is that possible? I think a lot of it is going to have to do with the data that we get and obviously the macroeconomic landscape. And then the biggest thing to mention before we get into the thing that happened on Friday that I think was very exciting for a lot of people is this data around the Fed. I mean, the Fed probabilities for a rate cut went down below 50%, which is just really annoying. Right now, it's at 45.8%. Everything that I've looked at, and I'm not the greatest economist in the world, but everything that I've looked at is telling me we really need to cut rates. And the idea that we would leave rates unchanged, if you look at subprime auto delinquencies, credit card delinquencies, layoff reports, and we're going to look a lot of that stuff tonight. It signals that the Fed has absolutely lost their mind, thinking that we can leave rates like legitimately lost their freaking mind. And it's going to be very interesting to see what happens. Now, the way this probability goes back up to 80%, like it was a couple weeks ago, is if we get a pretty bad labor report on, I think, November 21st. It's in about 5 days. We're going to get that labor report. And I think that's, going to be pretty obvious to the Fed to cut rates, but that's going to be one of the things that we all are going to have to keep our eyes out on to see what's going to end up happening with rates. Having said that, the biggest story of Friday, we got 6 minutes until the overnight markets open, was Berkshire bought 18 million shares of the Googs. Lots to talk about here. Would love to know what people are thinking on this. People are saying their estimated price is $243. They're getting that from a website that's just showing the reported price. None of those websites actually have the actual price. It is a $5 billion stake if you multiply 17.8 million times the current share price. I don't think his average is 243. It might be a little bit lower, it might be a little bit higher, but once we get the actual filings from Berkshire, we'll be able to know exactly what price they paid. As of now, all we know is that sometime in Q3, so August and September and July, they bought Google, which is pretty crazy because Buffett and Berkshire, the philosophy of their firm is not to touch technology companies outside of Apple, but they touched Google, which I think is very exciting. Here's a clip of Buffett from 8 years ago explaining why they bought Apple, and we'll try to compare what that means to why Berkshire is potentially buying Google.
Volatile stock. It kind of traded in this boom and bust cycle. Every time they had a new phone that came out, it would push the stock higher. If they didn't have a new release, it would drop. He said that it's still 65% of the business, but a lot of people are maybe looking at it a little differently. And he wonders how you look at it. Is this a boom and bust cycle, or is there something different?
Not in the least. I don't, I like to see the new release do well, or, that, but I do not focus on the sales in the next quarter or the next year. I focus on them. They won't tell you exactly how many, but hundreds and hundreds and hundreds of millions of people who practically live their lives by it. And if you look at that little piece of whatever it is, that is some of the most valuable real estate in the world. I mean, that is Fifth Avenue will never come close to that. I mean, it is. You've got hundreds and hundreds of millions of people with loads of buying power and able to do business or learn information or whatever it may be, and it's part of their habit of living. I mean, they spend hours a day, and it does all kinds of things for them. So that real estate is worth a fortune, and it's nice to have it added to as they sell new phones. And of course, a lot of them are replacement phones, but that.
So as you can see, Buffett never, and there's plenty of other interviews of him talking about this, but Buffett never fully thought of Apple as a technology company. He thought of them as a consumer hardware play, and that consumer hardware had mass distribution. As a result, you could build a lot of business on top of that mass distribution. And the reason he ended up catering 20% for his career is because of Apple. In the last 10 years, they bought at a $500 billion market cap, and they basically sold at around a $3 trillion market cap. They still have a decent amount of Apple, but they did sell 16% of their Apple stake in Q3, and they loaded up 2% of the portfolio in Google. So to me, the takeaway here is that I think Buffett is, or I shouldn't say Buffett, Berkshire, because he's retiring, is validating a bit of the AI trade. And why do I think that? Well, they have more T-bills than the Federal Reserve. They have $300 billion in cash, and they never touch technology outside of Apple. I mean, they have missed every single technological change, revolution, play, and then the derivative stocks that were associated with that over the past 30 years. Buying 18 million shares of one of the largest CapEx spenders on the planet, which is going to spend about $100 billion next year on data centers, doesn't make sense if you think AI is a bubble. By the way, Google announced $40 billion more in data centers for Texas over the next 5 years on Friday. I mean, if you think the data center spend is stupid, if you think AI is not real, if you think the GPUs are fake, if you think there's going to be a ton of GPUs that are never used and all of this CapEx spend is going to go down the gutter, you wouldn't touch a stock like Google. Now, Google's probably a lot more resilient to some type of a bubble pop than like an Nvda, because obviously Nvda gets all their revenue from chip sales. Google has a lot of other derivative businesses besides their TPUs. So there's a lot of safety baked into Google. But nonetheless, if you think AI is fake and you think the Nasdaq's getting ready for a 20 to 30% correction, which is the chatter I've heard over the weekend, quite frankly, by a lot of different people saying they think Nasdaq's ready to go down in 2026 aggressively. I mean, why would Berkshire put $5 billion into Google? People are like, oh, that's only 2% of the portfolio. I mean, I don't know about you, but $5 billion is $5 billion. If Google's going to go down, by the way, they're FOMOing $5 billion basically at the top. I mean, they probably didn't buy literally Google at the top, but like it's been 20 years, right? They're not buying Google at a $100 billion valuation. So if you think the Nasdaq's got 20, 30% down to go, which Google will survive that, it's just Google's stock price will also get hit pretty bad, you would get a better return in T-bills. I mean, quite frankly, if you bought the 10-year treasury in November of 2024 over Bitcoin, you have done better than Bitcoin, which is because Bitcoin's price action today officially went negative for the year. It's bouncing back up now, so now it's up like 1% for the year. But when it was at 93, it was negative for the year. So why would they buy Google at anywhere near $200 to $250 if you thought there was some massive AI bubble that was getting ready to pop? I mean, it doesn't make a lot of sense to me. And I also don't think you take a $5 billion position in something that you're going to flip in the next 90 days. Like, that's just not how Berkshire operates. If that is how they start trading, then I think they're going to inquire a new class of investors, because most people that buy Berkshire are buying into a long-term thesis. That's how Berkshire has taught a lot of their disciples on investing. And also, this is a holding company that sells out entire arenas of shareholders. So the amount of people that I think are going to buy Google, the amount of people that bought Google purely because, or Apple purely because of Buffett getting in, I think that same effect could take place on Google. And if they are getting ready to hold it for a long time, then obviously that would be really important as well. All right, here we go. Overnight markets. It is 8 p.m. Eastern. They are now open. And let's see what we've got. Futures are green. S&P 500 up 0.26%. That goes green, 673. 69 Palantir, that's up about 1% after hours, 175.50. Nebius, that's up 3%. 86.02. IREN, that's up 2.8%. Rigetti, that's up 3%. D-Wave, that's up 3%. Bitmine, 1.74. That's up. Tesla, that's up a little bit. Rocket Lab, that's up 1.19%. Robinhood, that's up 1%. Robinhood, even with crypto coming down, Robinhood going up is very good. Google, of course, Google making a move. There you go, 292. Again, you've got millions. I mean, one could argue tens of millions of people that follow Berkshire religiously. They are not going to fade Google if Berkshire's next big bet is Google. So I think that alone is going to justify Google, potentially going higher. Obviously, we'll see tomorrow what happens when the market opens. But Google right there, 293. That's up 5.63%. Last time Google was touching the 290s was after that massive earnings that got disrespected a week later because we had the shutdown. But one could argue that they deserved to be at that since the earnings. Beyond Meat, that's up a little bit after hours. Webull, that's up a little bit. Oklo, that's up 2.8%. Amcor, that's up a bit. SoFi, 2.19%. Big Bear AI, that's up 1.82%. Nubank, Howard Marks bought $72 million of Nubank. They also had a massive quarter and they crushed it as well. VG's up 1%. Lennard's up a little bit. That's a home builder. Where is Tesla? Tesla is up 0.5%, 406. Did Netflix do their split? Well, it's up a little bit. I don't see the split on Webull yet for Netflix, but I think the split's happening tomorrow. So then you'll see that. Nebius right there up 3%. Again, IREN's up 1.23. Gold is green. Gold is not Red, gold's at 4,100 basically, so up about 1/3%. So gold is doing okay. Verizon's actually down, so that's showing a little bit of risk off from the markets transitioning into risk on, and kind of the whole last week was risk off. Meta right there, that's up a little bit, 610. Meta did fall below 600 on Friday. Oracle 223.98. Oracle fell to 210 on Friday. Again, Friday was ugly. If you didn't pay attention to markets on Friday, then it probably helped your mental health. But if you if you looked at your portfolio on Friday, at least during the day, it was ugly, especially in the pre-markets. But bull stepped in. Around 663 S&P, bull stepped in. Nvda, that's up 1%, 190, 195. We'll preview Nvidia earnings. That will be on Wednesday. We'll have a lot to talk about with Nvidia, but that will happen as well. Yes, we do have that headline from Buffett. Buffett said that the U.S. is planning to have the trade deal finalized with China by Thanksgiving. Now, Buffett says a lot of things. Sometimes they're true, sometimes they're not. That could be another reason why the market is happy. But we're going to have to see if that ends up happening by Thanksgiving. UNH, that's actually down. Oscar, that's up a little bit. Lemonade, that's up a little bit. CNC, that's down. Elevance, it looks like, is also down. Yeah, Elevance is up a little bit. All right, so healthcare is a little bit selective. David Tepper sold 92% of his UNH. Buffett did not sell any or buy any of his UNH either. So Buffett kept it. Grab doesn't trade after hours, so we don't have pricing on that. Amazon right here, that's up a little bit, 0.32%. Amazon went from 255 all the way down to 232 on Friday. HIMS 37.20, that's up about 0.5%. And then again, Tesla for 405.44. Farzad said, I started position Lemonade late last week thanks to the 1% IRA match on Robinhood. Shout out to Farzad. He is officially a Hoodie Gang member, which is awesome. They gave him a nice little incentive to take his Tesla stock and bring it over to Robinhood. Lemonade right there is $70.49. I mean, Lemonade had great earnings. They were up 30% from earnings. And so it was not too bad. For those wondering why Google is up so much, again, Berkshire took a 18 million share stake in the company. And that is why the market is rewarding Google right here. CoreWeave, that's up 1%. This one got absolutely decimated over the past 2 weeks. And, there's a lot of issues with CoreWeave's debt that the market's not liking, but nonetheless, that one's trying to find a bottom around that 75 level. Lilly, this was on a run all of last week. Lilly down just a little bit right there, 1,024. SMCI, this one also got hit last week. SMCI up a little bit, 1%. EOSE, does that trade after hours? It does not. EOSE was down 9% on Friday, rebounded a little bit after hours. We'll talk about the high beta momentum names, the EOSEs, the Oscars, et cetera. I mean, they all are pretty much taking 30 to 40% drawdowns. And so we'll kind of look at all of them together. But I think, at the end of the day, it's healthy. A lot of the names were getting really, really up there, and those getting flushed out is not the worst thing in the world. And the ones that put up the right earnings out of those companies are going to rebound, and they're going to rebound and get a lot more momentum. But at the end of the day, they got to show some earnings. HIMS right there, that one's also up a little bit. And then Amazon up 0.3%. Cypher does not trade overnight. IREN is, I think, one of the only Bitcoin miners that trades overnight. Does Bitfarm trade overnight? No, it's pretty much just IREN. IREN right there. IREN also been getting hit from 80 to 46. That's up 2.2% after hours. Again, IREN, still up 4x for the year, even with this drawdown. So a lot of these names still doing well. And then you got Nvidia right there at 192 after hours. Okay, cool. That is what we have on the overnight markets. We got a lot of headlines to get into, and we'll talk about a variety of different things. Nebius right there up 3.3%. Again, the S&P 500 up 0.2. Palantir 174.87. As that is green as well. AMD is 247.91. AMD actually did a pretty nice job last week. I mean, after getting up to 265, then falling down to 224, rebounding to 246. I mean, if it stabilizes around 250, that would not be the worst thing in the world. So I think AMD actually had some pretty strong price action without getting hit too bad. And yeah, Google right here, 293. I mean, look, does this thing run to 300 now that Buffett's in? I don't know, but it would not surprise me. That is, I don't think we can even, I don't even think words can put into reality how serious it is for Berkshire to take a stake in a company like this. Like, they're not buying some random insurance company. They're buying a company that is universally known. They're buying a company that's up 60% this year after the run. They didn't buy at 150, or 130 last year. and they're buying a company they would never touch. You know, Munger has some interviews from back in the day where he's talking about how Google was the biggest stock they missed and how he was so regretful that they never ended up investing in Google. So the firm has always had a positive view towards Google. It's just their anti-tech bias for, you know, whatever reasons they were not a fan of in technology investing that led them to miss it. And so for them to finally admit, wow, Google 6.2% touching 294, the fact that they're finally admitting it's time to get in is quite incredible. And I think that will be rewarded by the markets very nicely. Micron right there, that's up 3% as well. Gemini 3.0 next week as well. Yeah, you got a lot of the prediction markets saying Gemini 3.0 is going to be pretty phenomenal. I mean, you got some people speculating that Berkshire got a little bit of an early taste of Gemini 3.0 and they're buying it ahead of its release because they just know how powerful that model is going to be. You know, you got a lot of different AI researchers saying they think it's going to be the single best model on the planet, 2.5 Ultra, and the enterprise workflow adoption of that was, you know, pretty strong compared to ChatGPT or Grok 4. So Gemini 3 can also be a big deal. Micron right there, that's up 3.3%, and then you got the S&P 500 again up 0.22%. Where is Bitcoin? Are we getting a little bounce? Yes, 95, a little bit of a bounce from 92. And then Ethereum, 3,100. 3,100 on ETH. All right, cool. So not a bad overnight markets. With all the crypto stuff that I saw over the weekend, it really did feel like crypto, or it really did feel like the entire market was going to take a little bit of a breather. And the fact that the market's somewhat stable and crypto is kind of trying to put in a bottom is good. So that is good to see as we get into the third week of November. All right, so let's get into it. A lot of stuff to talk about. I think we'll start off with a few headlines, and then we'll go deeper into a variety of different things that we've got going on. First of all, I just want to play this quick clip from Tom Lee on Friday. Here's what he's thinking about the choppiness in the market and what he's expecting for the end of the month.
All right, let's pivot to the market itself. Is your confidence at all shaken in where we are and what you thought the prospects for an end-of-year run could be after what we've seen this week?
Well, it's never fun to see markets wobble and then stocks that are quite popular like AI and the quantums and nuclear come down so hard. But it is consistent with the idea that, you know, we were up 6 months through October, so the market's overbought. We expected 2 weeks of consolidation, which is what we're getting. And then, of course, as you know, there's hawkish Fed talk, so there's a bit of a tantrum the market's having. But between now and year end, we still have really good seasonals. The earnings have been good. Sentiment has flipped negative, Scott, as you could tell. I mean, the AAI went to negative 17.5. So I'd say the risk reward is still really good for equities into year end. And yeah, I think the S&P will be over 7,000 by the end of the year. You know, in fact, maybe over 7,000 by the end of the month.
Okay, so you got Tom Lee that's still calling for an S&P 7,000, which was about 5% away. So, I mean, it's not impossible to imagine that that could take place. This was one of the charts from their newsletter this weekend, and here's what they're predicting. So 2022 S&P 500 returned negative 19%. 23, you had 24%. 2024, you had 23%. 2025, they're estimating a 21% end-of-year gain for the S&P 500. We have about 16% of that right now. And Tom is expecting another 5% of that would happen in this fourth quarter chase by end of year. The argument here that they're making is that fund managers are judged on their 3-year performance. And if you do end up getting a bit of a run on the S&P 500, you know, if those 3 years end up checking out negative for certain fund managers or just like vastly underperforming against the benchmark, which if the S&P is up 20% 3 years in a row, then you've got to be at least around that ballpark. That could lead to a chase. I think that is possible. I think the opposite is also something that everyone just has to be aware of, which is that if the market ends up coming down, the benchmark becomes less attainable because obviously markets are coming down and, you know, clients would be willing to listen to the apology of not being able to deliver good returns, because if the entire market's losing money, then, you know, you can't be mad at your fund manager for losing money. So if you do get any level of a drawdown because of something related to the macro, and we'll talk about some of the different things that we have going on next week from a macro perspective, then maybe that end of year chase doesn't happen. So realistically, you're going to have to see that chase start in the next week or so. I mean, I doubt it's going to happen towards the end of December because by then everything's priced in and markets are forward looking. So any of that forward pulling of growth that the market would have to start to allow for the chase like within the next week, at least after Nvidia earnings, I think we would begin to see that thesis play out if that thesis is going to play out. But that is one of the core arguments that you have from Tom Lee. Second argument right here is, so let's take a look at the momentum drawdown. Goldman Sachs right here said on last Friday, we just had the biggest one-day drawdown in high beta momentum since the DeepSeek debacle. This is as per Goldman Sachs trading desk. And this makes sense, right? Your Oklo stock, your quantum, your nuclear, your crypto play, obviously MicroStrategy, BMNR, all of these got hit pretty bad. And worse than your average Mag 7, right? Tesla's still holding 500 or 400. Apple's still holding around the 270s. But an Oklo is down from 193. So, and you know, it went below 100. Now, the question is was that the bottom on Friday on all of these high beta momentum names? Or does the market say, you know what, we really, really do not want to trust these companies that are putting up no earnings, have no fundamentals, and quite frankly, are just built off hype, a lot of that hype being constituted by retail investors. Do we want to just finally take it out and say, you know what, that money's got to go to Nvidia, that money's got to go to Google, now that Buffett just validated Google, like that money's got to go somewhere else? Or does it kind of say, nope, that's enough for Oklo, 193 to 97 is enough, and that's going to move forward? And by the way, it's not just the Oklos, it's the Rocket Labs of the world. Rocket Lab was freaking $74 at one point. It's at 46. I mean, it's a pretty ugly draw, and it got to 41 on Friday. So ASTS was at 102 at one point. ASTS now is at 62. I mean, a lot of these, and the Rocket Lab to me is like a company with a lot of fundamentals. It's not some random meme stock, but nonetheless, it did get a bit expensive, and the market took a lot of that premium away. So the question becomes, or was Friday the bottom on a lot of those names, or was it not? And I think this week's going to be very important with Nvidia earnings coming up and macro data being released to kind of give us an understanding of, hey, does the market actually think that these prices are sustainable even at these levels or not? And, you know, obviously on a personal basis, you have to, if you're heavy in Rocket Lab, you've got to believe in Rocket Lab, right? If you're going to be invested in it, same thing with a Palantir or a Hood or a Tesla or any of these names, all of these are high momentum. Now, their drawdowns compared to like the Oklos of the world that have no earnings are different, but you've just got to ask yourself how much you believe in their multiple and your ability to hold them for the long term when you're dealing with a high beta drawdown. My gut tells me Friday was a little bit more of the flush out. And, you know, if an Oklo still goes down more, again, it affects a very small part of the market. It does not affect the companies that really fundamentally matter. But if it's not, then I think people just have to be prepared for a little bit more of a drawdown. And quite frankly, the companies that really do have fundamentals like a Rocket Lab, if you see a big dip on that, those dips get eaten up. On an Oklo, I don't know if that dip, or a Quantum, I don't know if people step in. But I think on a Rocket Lab, people do. And so I think a lot of those are going to get compared over the coming weeks. 2026, what's going to happen in 2026? Well, I found a chart this weekend, and this chart is not pretty. Let me just say that right here. It's an ugly chart, but nonetheless, it is data that we have to be aware of. Every midterm year since 1950, every single one has had an S&P 500 peak to trough decrease of average of 16%. I mean, it's kind of spooky how every freaking midterm year this ends up happening. The last one you had was in 2022, 25.4% down. Obviously, that was pretty ugly. And, you know, we all lived through that one. 2018 was 19%, 2014 was 7%, and on goes the declines. The question is, does that happen in 2026? Now, the 1 year later return is on average 33%. So you make up all of the return that you had lost in the previous year, and then it doubles on average going into the next year. The question is, you know, do we end up seeing that in 2026? And I think obviously one chart is not everything. There's, you know, plenty of different historical precedences that have been violated in 2024 and 2025. The 2-year, 10-year spread has been one of the biggest ones that every economist said, hey, we're going to have a recession. That never happened. The Somm rule, remember Claudia Somm was getting all this attention. There was some big rule that after that rule is triggered, then boom, you have like this massive layoffs, unemployment. That was supposed to happen early 2024. That didn't happen either. So you can't use all those arguments as like the number one reason why you're going to have pain. But nonetheless, it is something that we have to look at on a historical basis. And then I found another chart right here that kind of goes at odds with this to an extent. After a shutdown, a year later, the S&P 500 is up 19 out of 22 times and up better than an average of 12.7%. So the first chart says that in a midterm year, the S&P 500 is down 17% on average. The next chart says after a shutdown, the year later, which would be 2026, because we just had the longest shutdown ever, you're up on average 12.3%. So you got two different conflicting data reports that are going to be going against each other going into 2026. And obviously there's going to be a lot more macro and AI related news that's probably going to inform this stuff, probably policy related news as well. But nonetheless, you've got two different competing arguments for what the historical precedent would look like going into 2026. And I think it's going to be a lot more nuanced to this, but it's definitely something that we have to keep in our minds. By the way, Google continuing to move. Wow, 296, 7% on. You could have even bought Google on Friday after hours and still be up 7%. Goodness gracious. Hell of a move right here. I mean, it looks like it wants 300. And quite frankly, this could lead to a little bit of a decline in crypto and a little bit of decline in other high beta names if people just sell those and say, I'm going to pile into Google. 296.22 right there, up 7%. Oracle getting a nice move as well, 2%. The reason Oracle fell last week, by the way, and took a lot of the data center plays with it is because their credit default swaps went to the highest level in over 10 years. There was a lot of investors buying protection on Oracle's debt, which I think is a fair thing to do. Oracle basically is going to have negative free cash flow over the next 5 years because of the amount of debt they're taking out. But, it also did give up a heavy amount of it gave up pretty much all of the run it had to 350. So one could say that, might be a little bit more de-risked. And number two is that if there is an ROI from what Oracle is spending all this money on in data centers, they have a $300 billion contract with OpenAI, then their debt is going to be very secure. So I understand investors wanting to get some protection against their debt, but there also just might not be the need for that much protection if the ROI is there. So I think that's one thing we have to watch out for Oracle. I love Google, but this is a bit too much. Well, so the thing about these names when you get blessed by the Oracle of Omaha is, do they become overvalued? I mean, I don't know. I would have to look at the multiples again. From my understanding, at 270, Google was trading at a relatively reasonable 2027 forward multiple at like 310, 320. I'm not sure if that becomes as reasonable anymore. But you're definitely going to get people that get excited for that. And that's why Google right here is green. So 296 on the Googs. Tesla, are we moving on Tesla? Tesla down, 401. After hours, Tesla was green. Now Tesla goes red as Google goes up. Okay, macro with the administration. So what did Bassett and all of the others say over the weekend? Well, they had a lot to say and a lot to try to justify what is going on in the economy, especially around affordability. I know people are probably tired of hearing that term, but nonetheless, that term is being used more and more. Let's get into a couple of different things. Here's the first thing Bassett said to justify the reason beef prices are as high as they are.
But what is your take on what you just heard? He's expecting $10 meat.
Well, Maria, the beef market is a very specialized market. It goes in long cycles, and this is the perfect storm. Again, something we inherited, and there's also, because of the mass immigration, a disease that we've been rid of in North America made its way up through South America. As these migrants, they brought some of their cattle with them. So part of the problem is we've had to shut the border to Mexican beef because of this disease called the screwworm. So we're not going to let that get into our supply chain. And again, I don't want to focus on one product. It's a very important product, and we are laser focused on this issue. And
so his argument is expensive illegal cows are the reason why beef is surging. I don't fully understand the extent of that argument. I'm not necessarily the best cattle expert, but I think a lot of people are not really buying that argument. And, the big headline over the weekend outside of this was that Trump is officially going to be lowering prices on beef, coffee, bananas, and a variety of other things. Not lowering prices, lowering tariffs in hope of getting those prices to come down. Look, I don't really care about politics. So you guys know I don't give a shit about left or right. You can believe whatever you want to believe. I just think logically, if you're lowering the tariffs on items that you already tariffed, remember Brazil, we gave a 50% tariff. That's part of the reason why coffee prices are up so much, because we import a lot of coffee beans from the place we just put a 50% tariff on 3 months ago, you're explicitly admitting that the tariffs were not a good idea in those instances. Now, you may argue that the tariffs were very strong in negotiating with China or India or South Korea or whatever. But in this instance, you're obviously making an appeal to the American people by saying, hey, we're lowering the tariffs so that the cost of all these foods are going to come down, which is admitting that putting on the tariffs probably increased those prices. So I think to one extent, the Trump administration is defending the tariffs, as you're going to see Bassent say in the next clip. But to the other extent, they are obviously admitting that they had to decrease some of those tariffs to get these prices to come down.
Let's say this in the strongest possible terms. I think that there are 3 points here. Is one, this is one of President Trump's signature policies, and traditionally the Supreme Court does not interfere with a president's signature policy. 2, this is an emergency authority, which is IEPA. President Trump has successfully used that. To, as we talked about earlier, on the rare earths problem, he threatened substantial tariffs on China, and that made the rare earths flow.
Yes.
2, numerous of the peace deals that he's negotiated, he threatened to put tariffs on the countries, and that got us to the peace deal. 3, when we're talking about fentanyl, we had fentanyl tariffs. And what is more of an emergency than hundreds of thousands of Americans dying every year? No one had been able to get the Chinese to the table with these precursor drugs.
Right.
And then 3, I would push this back onto the Supreme Court. I don't think this ruling is going to go against us. But if it does, what's their plan for refunds? Because how is this going to get to consumers? Are they just going to hand the some of these importers big windfalls? What if the exporters have given big discounts already, and then you're going to give a refund on the tariff? So they'd be making it on both sides. So I don't think the Supreme Court wants to wade into a mess like that.
Yep. When do you
say this?
So you've got Bassent making some logical arguments here, which is that we wouldn't be able to get the Chinese to negotiate with us if it were not for the fentanyl tariffs. And, based on how the Trump administration has negotiated, or at least set up a negotiation for a framework for a deal with China, one could argue that, yes, those tariffs were absolutely instrumental. It's just the broad-based application of those tariffs everywhere. Obviously, now that they're rolling them back on certain types of products like coffee and bananas and beef, likely mean that they were a bit misguided. So there is a bull case of the tariffs. There is now a more explicit bear case based on the Trump administration admitting that some of the tariffs they need to take off. The question becomes the Supreme Court case, which I don't know what's going to happen. And we should get a result by the end of November. By the way, Nebius right there up 5% along with Google. So both of those making a little bit of a run in the overnight markets. The question is if the Supreme Court is actually going to think of the material implications of completely reversing all of the deals that have been negotiated through the tariffs, because if the tariffs are illegal, then Trump can't say that he has all these deals because a lot of these countries might want to renege on the deals. Or do they uphold it? And I don't know. There is a lot of different nuance to this. I've read a lot of different think pieces by people saying that there's no way in hell the Supreme Court upholds it. Maybe somehow the Supreme Court comes in and says that there's a constitutional way to justify it. But at the end of the day, I think the more sane case, without going super left or right, is that the tariffs have been useful in certain situations, like getting the Chinese to talk. And Trump is right that in terms of certain countries that have been at war, a lot of the tariffs have been used as a way to say, hey, if you don't stop fighting with this country, we're just going to tariff the shit out of you. Those are meaningful ways to use it. But the broad-based application on certain goods and services obviously have not been the best. And now the administration is trying to really fight back this affordability narrative, because they know the midterms are not going to be that pretty if the affordability of the country does not improve. And speaking of affordability, that gets us into the next topic, debt. It's going up. Mortgage debt, 13.7 trillion, all-time high. Credit card debt, 1.2 trillion, all-time high. Student loans, 1.65 trillion, all-time high. And then auto loans, 1.66 trillion, all-time high. This is the reason why you think you're seeing a lot of people talk about affordability, because debt is up there. And then when you take a look at this chart right here, U.S. delinquencies are continuing to rise. 12.4% of credit card balances are seriously delinquent. Serious is defined as 90 days plus. This is the highest since Q1 of 2011. Auto loans, we've been talking about that a lot. 90 days overdue, that's 3 months, is 5%, highest in 14 years. And then student loans is 9.4% in terms of delinquencies, the highest since the second highest since 2020. Student loans is the least surprising to me because after it being paused for 5 years, now that people have to pay it again, like you would imagine people just kind of forget that they even have those student loans. But the credit cards and auto loans are the ones that are reaching highs that we haven't seen in the past decade. And that's not necessarily the best thing to see. So does that mean we're getting into a bear market? I don't think that's the case. Like, I don't think you can just define, all right, bear market because consumers are struggling. However, it's definitely something that complicates the bull argument. And you can see with Bassett and Hassett and Trump talking about affordability, they're understanding that if we don't fix the affordability problem, or at least we don't have the perception of fixing the affordability problem, we're going to get our asses handed to us in the midterms. And if we lose in the midterms, we're not going to, it's going to be a lame duck presidency. You're not going to have any ability to do anything for the next 2 years or for the last 2 years of the Trump second term. On top of that, the other reason I think affordability is becoming such a big issue is because if the consumer problem is as big of a problem as people think it is, i.e. that the rich consumer is not able to spend enough on goods and services based on the wealth effect and seeing, their Nvidia stock go up 50% to subsidize the bottom end of the consumer, which ends up keeping earnings growth stable. AKA if, 10 people making less than 50,000 a year can't buy a Starbucks coffee, you have one person or two people that have, did really well in the markets and they buy a lot of Starbucks coffee. So that subsidizes Starbucks earnings. If that goes away, AKA those two rich people or two, I guess, middle-class people can't continue to buy the Starbucks coffee because even they're like, yo, enough is enough. Well, then the stock market goes with it. And if the stock market goes and the low-end consumer goes and you have a tariff reversal and then you have this whole affordability narrative going the opposite direction, just gets ugly. So I think that's how the administration is thinking of it because they know that if Starbucks earnings go out the window because even middle-class people don't have the resources to be able to continue to buy that additional cup of coffee, things get ugly. I mean, this president, the one thing that he cares about is the stock market. If we lose the stock market, that is not the best. So I think that's the most important thing we have to keep track of over the next coming days. And a lot of that's going to be implicated through the data that we'll talk about in a second. And that data is going to have to do with the labor market, which hopefully gets the Fed to be more inspired to cut rates. Here's Gavin Baker as well, trying to defend what's going on with affordability.
The president claims that Thanksgiving costs are down 25%. I mean, does he know that's not true?
Well, if you look at Walmart and the few places that put out their prices of Thanksgiving
wait a minute. I got to stop because the Walmart comparison's like not a thing. I mean, Walmart had a Thanksgiving package last year. They've got a Thanksgiving package this year. The one this year contains much less than what the one last year took. So that's why the price is less. Look, we got a chart here. Last year, it was 21 total products. This year, it's 15. Total number of items in those products was 29% now. 29, now it's 22. There's more generic brand stuff. So, I mean, Thanksgiving, if you're going to the store to buy groceries for Thanksgiving, it's going to be more expensive this year.
I really don't understand where you're going in the sense that Joe Biden gave us 20%
He's not
inflation.
president. Donald Trump's president.
No, and you want us to fix the hole that Joe Biden does right away.
Why does the president tell
the prices went up so much under Joe Biden and inflation is way down. Inflation is about half what it was in December. This is something that's being fixed fast and real incomes are up after dropping about 3,000 under Joe Biden. And so sure, you can find a few things where the price is higher, but there's a whole bunch of stuff where the price is lower, like gasoline, like mortgage rates.
Get the Republican plan.
You understand that mortgage rates have gone way down, and it's much cheaper to buy a home now than it was when President Trump took office.
Down, right?
Yeah.
So
there is a lot of this argument from the Trump administration officials on Biden ended up giving us, a bad deal. And look, they could be right on that argument from a technical perspective. It's just at the end of the day, not a lot of people are going to care. Right? I mean, at the end of the day, people are not going to want to listen to excuses. They're going to want to know when will the prices of a lot of their goods and services come down. So I think the administration knows that. And because the administration knows that, they are trying to do whatever they can to have a meaningful way to reduce these prices and make things more affordable. I mean, Trump literally said last week, we are going to make America affordable again. But I think that's going to be the next big thing that the administration is going to have to focus on, which gets us into this jobs report. So we should be getting the jobs report over the next week. And this jobs report is going to be super, super important. We looked at a bunch of data last week. And last week, obviously, the data was not good. Well, there were two things that happened last week that I think really spooked the markets, even though we ended up recovering by Friday. Number one is that we got all this third-party data saying that the jobs that we added back in October, remember ADP said it was 50,000. ADP came out and said, actually, it's negative 42,000. So they said we lost 11,000 jobs a week in the month of October. That wasn't good to see. So that in and of itself, you know, one of the only third-party reliable sources of private payrolls came out and said, yeah, things are not going as good as we thought. And then number two is that the White House came out and said, you're not going to get the October report. So if we're not going to get the October report and the jobs data was already bad, then you've got the entire market wondering, wait a second, so we don't have the data on what happened in October. We're never going to get the data on what happened with October. And now we have to wait another month to be able to see what ends up happening. Like those two things were just not good to see. Now, I think there's a lot of different bullish arguments that can counteract those things. And you saw that in the price action. I mean, Nvidia ended the week at 191. So as ugly as you would imagine those headlines were, you know, Nvidia being at 190 is not really that ugly. So then the question becomes, why did investors buy stocks? Well, because things got cheap. And as things got cheap, people overlooked the macro concerns about the labor market. And they said, you know what, I need to buy equities, which again, that's been kind of the vibe of this entire year, right? Like things go down, people buy the dip. That has continued to work. And as long as that continues to work, we're going to be able to take some of the hit on the labor market stuff. But it gets to a point. And I think when we get the labor market report going into next week, it likely will be negative, or at least not positive. And this Fed probability of 45%. I mean, quite frankly, the only thing that I think can save the December rate cut, which is overwhelmingly starting to look like we're not going to get it. I mean, you had one of the presidents last week, Fed President Logan, who said we should be hiking. The fact that there's any chatter about hiking when auto delinquencies are at a 14-year high, I mean, like already mortgage rates and auto rates are starting to become unaffordable to the everyday American. And the idea that we would hike that by an extra 25 bips, I mean, that would be unfathomable. So like the only way that flips is if we have a pretty bad labor market report, AKA bad news being good news. And the nuance has to be that the labor market can't be so bad that it messes up earnings, because then stocks go down, but it can't be so good that we don't get a rate cut, because if we don't get a rate cut, I don't know if S&P 7,000 is possible without getting that one rate cut. And you saw Tom Lee on Friday try to kind of spin the argument, and he said it's not a spin, but basically it was a spin, right? His argument was, well, if we don't get a rate cut, that means the economy is doing okay, so technically stocks should be fine. And he's not like actually wrong on that. I mean, 2024, 2023, we had really good years and we barely had any rate cuts. So like he is right that stocks have shown the resiliency to go higher in the midst of higher rates, but it does feel like this market is priced for another cut. And if we don't get it, I think that could be a little concerning. So that's what we're going to have to see. Michael tweeted over the weekend. Yes, Michael Burry tweeted a couple hours ago. I don't know what he's launching on November 25th. He did shut down his entire fund. So that did happen last week. I think he's going into content creation because it looks like a blog will be launched. And I think that blog is going to be dedicated to the AI bubble. Genuinely, I think that's what's going to happen. So this is what he tweeted over the weekend. This is a chart of S&P 500 total capex less depreciation divided by nominal US GDP. And at the top of the chart, you see the NASDAQ 100 all-time high, fourth quarter of 2025. He's basically making the comparison implicitly to the dot-com bubble by using this GPU depreciation argument divided by GDP. And then the caption is, one chart to refute them all, to be continued November 25th. I think he's basically going to launch a blog or some type of media service that is dedicated to talking about what's going on in the economy. And, you know, maybe that's rooted in like his concerns around AI or what's going on. But yeah, I guess that's one thing we'll keep an eye on. But he is still hung up on this argument about depreciation and GPUs being like the biggest accounting fraud in history. We watched the video from ticker symbol U on Friday, and it was a short clip where he talked about how Nvidia software has various updates on their chips that allow the GPUs to be allows them to be effective for, on average, about 2 more years. So you would argue that companies don't have to depreciate them as aggressively, which would like lead to this sort of a dichotomy of earnings growth that Michael Burry is talking about, because they get more of a life cycle out of them. And, you know, I think we've seen this already with a lot of companies still being able to use the H100s, even if they're not fully on the Blackwell chips. So that's one retort to that argument, but nonetheless, he feels pretty passionate about the idea that this GPU depreciation is horrible for earnings growth, or at least it's overstating a lot of the earnings growth. Having said that, Yeah, this happened over the weekend. Elon responded to Sundar, CEO of Google, who just tweeted the 40 billion of data center spend they're allocating in Texas. He says it's mind-blowing how much money is being spent on AI compute so fast, but still many orders of magnitude to go. And then Sundar says between abundant sand, plenty of sun and space, literally to put it in, we can do it. So you got Michael Burry saying this whole GPU AI CapEx stuff is a full-on bubble. And then you've got Elon, who wants to literally start his own chip farm, as he talked about a couple of weeks ago, and Sundar, who wants to put data centers in space. So to me, when I look at, two relatively competent CEOs of multi-trillion-dollar companies saying that we need to keep this spend because the demand that we're seeing on our products, whether it's Gemini, Cloud, YouTube, Waymo, Google AI, Elon with FSD, robotics, etc., is becoming so dramatic and outstripping the amount of supply that they have, in some cases 5 to 1, that they are thinking of entirely new creative ways to build out these data centers, which are going to have a variety of issues on the US economy, especially in the context of like electricity prices. So like there are negative impacts to this, but the broader trend is up when you have these types of companies spending this type of CapEx. And that's super bullish. Nebius, Iran, all the Bitcoin miners that are transitioning to data center plays. Like if there is that much spend being allocated in the system, obviously there's going to be some third order derivative companies that are going to benefit from that spend. And, Buffett and Berkshire invested in Google knowing that they're ready to spend that money. Now, the really bullish thing that happens in the next maybe 5 to 10 years is when they stop spending all this on CapEx and that money goes back to free cash flow. But at least I would argue for the next 2 to 3 years, if we want to be super conservative, maybe 2 to 3 years is aggressive. I don't think it is, given the guidance we've got. You're going to see this spend. And that spend should be relatively bullish. So that's what we have in terms of what's going on with the data centers. Yes, it could be bullish Rocket Lab as well, if you need Rocket Lab to launch all those data centers into space. Peter Thiel did sell his Nvda stake. So Peter Thiel's fund came out with their 13F, and they did a couple of things. They sold all their Nvidia. They sold 76% of their Tesla. They sold 100% of their VST, which is another data center play. But they added Apple and Microsoft. So it's kind of weird. I mean, like, everyone's like, oh, you bearish AI. Peter Thiel just sold all of his Nvidia. I'm like, well, why is he buying Apple and Microsoft? Like, Microsoft's still going to spend a crap ton on CapEx. Apple's not, but nonetheless, you got to bet that Apple's going to meaningfully innovate next year to expect positive returns. So Tesla, I understand. I mean, Peter Thiel, at the end of the day, he is not really an investor that holds on to names that are super, super expensive. At the end of the day, Tesla trading at 200 times earnings. Peter Thiel is probably like, hey, I want to take some profits here. Nvidia, I don't think is that expensive. If you look at their earnings growth going into the next couple of years, I mean, trading at 27 times 2027 earnings is not that crazy to me, but nonetheless, you probably want to take some profits. But I don't understand why you would pile into Microsoft and Apple at the same time. And the founder of Microsoft, I mean, I thought this was even more interesting, ended up selling 60% of his Microsoft. Bill Gates, the Bill and Melinda Gates Foundation, sold 64% of they bought nothing in Q3. They managed $36 billion, and they trimmed 64.9% of Microsoft. I thought that was more interesting than anything else outside of the Berkshire buying the Google stake this weekend. But nonetheless, that was what Peter Thiel did as well. So that's what we got with Berkshire, Peter Thiel, and some of the trades over the weekend. We do have a headline on Russia and tariffs. Let me pull this up right here. Trump approves bill allowing tariffs up to 500% on Russia's trading partners. Huh. Okay. I don't know if they're going to select or if they're going to use this in a broad-based way against every company that trades with Russia or country. For example, India trades a lot with Russia, and we are trying to do a lot of business with India. But this does give them the power to deploy tariffs of up to 500% on other countries that do work with Russia. Now, granted, is he even allowed to do this? The Supreme Court's going to tell us pretty soon, is this legal or not? I guess for now it's legal until we get that decision. But there you go. You got tariffs on any partner that works with Russia as per the administration approving this bill that came out about 5 minutes ago. Yeah, again, I don't think they're going to use this against India because they're trying to get good relations with India, but they probably will use it against other countries that might be trading heavily with Russia, and that might be a negotiation tactic. Which, again, I am a fan of that. I think it is a good thing to have that level of tariff flexibility to deploy against adversaries in a way that allows you to do business with them and like get the job done to move forward with an effective trading relationship. It's just the broad-based application on a lot of different goods and services that Americans pay for. That's, what is potentially causing the fear of inflation with the Fed, which again, it's just so weird because, Jay Powell even 5 weeks ago was saying that the tariffs are transitory. Like, we all heard him say the tariffs are transitory, right? That's not me making it up. He said that multiple times. And now the entire Fed is afraid about tariffs causing more inflation. Like, and I'm starting to realize why people hate the Fed so much. Like, these guys have so much power and they say one thing and then they do the next thing and then they can't make up their mind. And this time, going into this end of year potential rally that we could be getting on the backs of rate cuts, which was 100% probability less than 3 weeks ago, now going to less than 50%. I mean, it's obviously pissing a lot of people off. And that's why you're seeing some pain in the broader equity markets. Not to mention, you're also seeing pain in the crypto markets. One of the reasons I think crypto is seeing pain is because we're not going to get juicy liquidity because the Fed might not be cutting. Here's what Michael Saylor had to say about what's going on with Bitcoin.
How low do you think Bitcoin goes in this cycle right here? If it goes any lower, where does it go?
I think it's pretty stable where it is right now. Yeah. I mean, most of the liquidation selling is out of the system. I think we should rally from here.
And then where do you think it ends?
I don't believe in 4-year cycles. They might have had some credence in the first 12 years, but right now, the 4-year cycle is somehow based on the idea that 225 Bitcoin a day get taken out of the supply after the next halving. That's $22 million or $20 million of buying. Trust me, $20 million of buying. The market traded 100 billion yesterday. 20 million is not even a third order issue at this point.
Yeah.
The dynamics in the market are much more that, Jerome Powell thinks he wants to hold interest rates higher for longer, right? It's macroeconomics, it's political, it's structural. When IBIT's derivatives market went from 10 billion to 50 billion, it did that in 4 weeks. I mean, so those kind of things, when JP Morgan, offers 10 or 100 billion dollars of loans against Bitcoin, that will dwarf the 4-year cycle. It's the actions of the mega finance actors that are determining the future of Bitcoin right now. And all the fundamentals are good. So my advice to anybody is, first of all, if you make decisions with a 12-month or less time frame, you're a trader.
Yeah.
If you're a trader, you're a trader. I have zero advice for you.
Right.
I'm not a trader. I'm not a good trader.
Yeah.
I don't purport to be. I have zero advice for you. On the other hand, if you're an entrepreneur or if you're an investor, you should have a time frame of 4 years or longer, 4 to 10 years.
So you have a bit of a breakaway from Saylor in this 4-year cycle. Here's what Hunter Horsley said. He's the director of the Bitwise ETF. He says, common view, people believe in 4-year cycles and that 2026 will thus be a down year for Bitcoin. First order effect, people thus sell in 2025 to avoid the down market year. Second order effect, the 2025 sellers causing 2025 to be a down year, thus breaking the 4-year cycle. Third order effect, 2025 is open season. 4-year cycle has been broken. I mean, it kind of makes sense because in the 4-year cycle, as you can see on this chart right here, the first 3 years are green. If 2025 ends up going red, then technically 2026 should make up for the 3 years that need to be green if you had a red year in the middle of that 4 years. So, I mean, maybe it makes sense. I personally just think all the institutionalization of crypto, as Saylor was saying, the fact that the banks are getting ready to give people loans against their crypto, particularly their Bitcoin as collateral, goes to show you how much an institution like JP Morgan, which, Jamie Dimon has hated crypto for the past decade, is starting to legitimize the asset class. Because if you get a loan against an asset, the bank obviously thinks the asset has enough value to let you borrow money against it. And I think that's going to be a lot more exciting. But nonetheless, crypto performance this year has not been that strong. In the face of that, take a look at this. Speaking of 13Fs, Harvard's endowment fund, their largest position and their biggest position increase in Q3 was IBIT, the Bitcoin ETF from BlackRock. They added $326 million to that in the Q3. That's not easy to do. You know, when you're an endowment from Harvard, you know, you're supposed to be just preserving the money, buying the stuff that's basic, not getting in trouble. You know, if Google goes down by 10% and you buy Google, no one's going to blame you. The fact that they're taking IBIT as their number one position is quite incredible, especially given the fact that, you know, I imagine a lot of the Harvard big economic professors don't believe in Bitcoin. I remember my Rutgers economic professor, you know, in 2017, when Bitcoin made that run to like 20,000, I remember everyone in this was Macro 101. This was Macro 101, was talking about it because all of us were like, that's the first time I downloaded Coinbase because I was like, dude, I gotta buy some of this shit. It keeps going up. And I remember us asking our professor about it, and dude, he absolutely shitted on the idea of Bitcoin. Magic money, fake, not real, you know, what do you call it? Money laundering, drug lords use it. I don't think the broader economic consensus in the elite class has changed. I mean, Paul Krugman did an interview. Dude, Paul Krugman is just, I mean, goodness gracious. I understand why people don't really love his economic analysis, but he was on a podcast recently and I tried listening to it and I was just like, it's kind of hard to, I mean, first of all, the guy hates Trump. And I'm like, that you can have your political beliefs, but goodness, like when I'm listening to an economist, I don't want there to be such political bias that it becomes impossible to like get the real gist out of their argument. But the guy hates Trump, so that influences a lot of what he's saying. And then two, he just absolutely hates crypto. And that's fine, you can hate crypto, but it's like the arguments are just so old and basic. There's not like anything unique. But yeah, nonetheless, I still think you have a lot of different people that just completely hate the ecosystem of crypto, but you get a lot of people that also think the 4-year cycle is not going to be real. Bitcoin right there, 94,940, and then Ethereum, 3128. Is anyone buying the crypto dip, or has anyone bought it over the weekend? Ethereum hit the low 3,000s, then it bounced. Bitcoin hit 92,000. I am really curious to see what the hell is going to happen when the market opens this week, and if crypto is going to be able to get any level of liquidity. If we get a bad labor market, does that hurt crypto? Do people run to sell crypto if they see the S&P 500 fall a couple of percentage points, or do they keep it going? By the way, Japan, their GDP came out this 2 hours ago. Their GDP was negative 1.8% on an annualized basis. The street was expecting negative 2.4%. So it was it was a beat in terms of the expectation. But they had their first quarter of detracting or contracting GDP for the first time in 6 quarters, so in about a year and a half. That does have an impact on Bitcoin. Why? Because this lowers the Japanese yen, and we all lived through the yen carry trade. The yen right now touching 130 over the US dollar. If that goes down and you got a lot of people that are long Bitcoin, short the yen, and they end up dealing with a carry trade again, guess what they're going to do? They're going to sell their Bitcoin to cover their yen short. So you got a lot of different macro things affecting Bitcoin in general and the overall crypto trade. But I think we have to see how bad it ends up getting. Bitcoin and crypto does have their own extreme fear and greed calculator, just like the equity markets do. And right now it is screaming extreme fear. We're going to see if that ends up being the case. But I think it's at an 18 level right now. And that's why it's getting it. Now, going a little bit more deeper in terms of what's going on to crypto, here's a couple of charts that I think are important to understand. This appears to be a structural and mechanical downturn. Institutional outflows started mid to late October. First week in November, you saw crypto funds have 1.2 billion of outflows, and the problem became excessive when you had a lot of leverage amid these outflows. We've all heard about perpetual futures contracts and the ability to go up to 50 to a 250x leverage on these positions. If you took out a 100x leverage position on Bitcoin, a 2% move would liquidate your position. In October 10th, we saw $19.8 billion get liquidated by one candlestick. That's when Trump tweeted what he said about China. So you had a decent chunk of leverage in the system that got hit. Obviously, that affected Bitcoin and Ethereum. Ethereum's down 35% since October. And then if you look at the entire crypto ecosystem, about $1 trillion has been, or sorry, 2.1 trillion has been lost since October. So my gut assumption here, and I'm not an expert on crypto, so I'm just giving my gut assumption, is that when you have that much structural leverage get wiped out, when you have all these funds continue to have outflows, that is a deleveraging event. That is not a bear market event. And I think the difference right here is a bear market is you assume that you're going completely risk off. And if you're going completely risk off, there's the fear and greed on Bitcoin. Then obviously these assets have a lot more to fall. If you're deleveraging, it's not really going risk off. I mean, you could even say Oracle had a bit of a deleveraging trade over the past month because people were so afraid of their debt that they issued after the OpenAI deal that people said, you know what, I want to take my profits. I want to kind of let things chill out and I'll get back in when I think things make sense. I don't think Oracle's in a bear market. I don't think Oracle's a fraud. I don't think Oracle's going to zero. And so it's the same thing with crypto, but nonetheless, Oracle might not be up another 40% next year. I mean, Oracle is still up 40% year to date, even with the drawdown from 350. So 34%. Does Bitcoin have that type of a move in 2026 if Bitcoin ends out negative? I think that's going to be the question that everyone tries to figure out. I see a lot of people here saying they bought a bit of crypto over the weekend. Some people saying they're getting ready for BM&R, MicroStrategy, again, MSTR, negative year to date. I mean, I really want to see if ETH can hold 3,000. That's my question. Because if it can't hold 3,000, obviously we're going to see a lot more pain, but it bounced literally off $3,003 today. So the fact that it even got that bounce, I thought was impressive, but tomorrow when the market opens, you're going to see a lot more trading volumes come in. Elon Musk, Tesla. Here's Elon saying optimists will end poverty in a more optimistic view of AI over the next decade.
So, but the reason for hand dexterity is you want to be able to do like surgery and precision medical actions. And so imagine a world where everyone has access to the best surgeons, literally everyone. And optimists will have a level of precision that is frankly superhuman, and will be able to do medical procedures, of very sophisticated medical procedures, any medical procedure, perhaps things that really humans can't even do because they're too difficult, and that will be available to anyone. People often talk about eliminating poverty and providing great medical care, but they never actually have a solution. And money doesn't solve it because there are only so many. There's a very limited number of great doctors and surgeons. They don't grow on trees, but now they'll get built in factories.
So, I mean, you got Elon posting a more optimistic view of AI. I know we've been talking a lot about the labor market and what's going to happen in the world of AI if the labor market becomes commoditized via robots and, LLMs, et cetera. And I think that's still a question around what happens to the labor market. But you got Elon with the optimistic view of, hey, we are going to eliminate the cost of goods being so high by massive, massive levels of deflation because the robots or the AI writ large is going to be doing all the things that we paid humans to do. And as those costs significantly go down, that will be a way in the mind of Elon to potentially eliminate forms of poverty. Time will tell. Time will tell. But obviously, you're seeing him take a more optimistic view. And, this optimistic view is going to be very important by a lot of the thought leaders of AI that exist in our society, because you had a politician over the weekend, Ro Khanna, who from California, who made an argument that said we need to seriously think about all of the AI innovation that's going on. And we need to potentially stop some of it if it's going to lower jobs. And you had David Friedberg come out with a super long response and basically say that you're an idiot and that there's no way that we can allow technology to stop progressing just to be able to save jobs, which is obviously the argument that a lot of the billionaire class and a lot of the arguments that are in the shareholder class are going to be promoting, because pretty obvious, AI increases margins, replacing humans increases margins, and increased margins increases shareholder returns. But you're going to have politicians that are going to come out against it. You really will. Look at this, Ro Khanna. We need eliminations or regulations that prevent companies from using AI to eliminate jobs to extract greater profits. Artists that these companies need to have a say in how AI is deployed. They should share in the profits, and there should be a tax on mass displacement. I think it is inevitable that there will be a politician that rises to power, whether it's a Democrat or a Republican, off the idea of protecting people's jobs by regulating the crap out of the AI companies, or at least taxing the crap out of them, to make sure that if Amazon saves, $300 billion over 10 years by replacing 2 million workers with robots, that some of that 300 billion comes to the government and gets redistributed in some way. But it just seems inevitable. If you're going to have mass unemployment, which again, it's a big question on how society is going to deal with it. Now, the optimistic argument is, costs are going to get so low that even if you don't have the best high-paying job, it doesn't matter. That's Elon's perspective. The other perspective is there's going to be a lot of new jobs that are going to pop up, and so all those new jobs are what's going to give people a meaning and purpose to life. No one knows how it's going to play out, but nonetheless, it is going to be a debate. And I think, for most of us, the only thing you can do is own some stock in those companies that are going to be engaging in that, because at the end of the day, in the midst of that debate, their share prices likely go higher on increased earnings, and that's what investors are going to care about the most. So that's what we got. That's what we got in the context of the labor market. Tier, thank you for the $20 super chat. Worst case scenario for 2026, the Fed is too late, recession. 2, earnings down, crypto winter. 3, LLM performance diminishes. 4, tariffs revoked or reimbursed. 5, Trump and GOP implodes. Socialism rises. And 6, geopolitics deteriorates. Yeah, I couldn't have said it better than myself. I think those are 6 legitimate concerns for 2026. And again, we're going to talk a lot more about 2026 as we head into the end of the year. I think it makes a lot of sense for people to have hedges. I mean, pick whatever stock you want to hedge against, but especially if you have if you have a huge Nvidia position, I think it makes sense to have an Nvidia hedge. Simple as buying puts on Nvidia. If you have a huge, leveraged position against the market being long and you're up 300% over the past couple of years, I don't think it hurts you to buy some puts on the SPY just in case things don't go as well. I don't think the way I'm thinking about it right now for 2026, and again, all 6 of these things are very reasonable to happen, and that could create like a bear market scenario. I don't think the argument is to get out of the markets. I think that's too extreme, and that's what Ashwath. We'll talk about Bill Ackman. I see you guys talking about him. Bill Ackman had a hell of a tweet this weekend. We'll talk about that. But I think Ashwath on the Prof G pod basically scared everybody for an hour and a half and said you should just get the hell out of markets because we're in a bubble. And I think that's too extreme. I think that's a bit too arrogant, and that's undermining the potential of not knowing what you don't know. These companies might end up continuing to outperform like they have over the past couple of years because AI is as serious as it is and it's as important as it is. But that doesn't mean to say the labor market can't fall off a cliff. The tariff implication of that being reversed could have issues in the market. Inflation could potentially flare up again, and the Fed might not end up cutting for the next 9 months. I mean, there's a lot of different arguments for why I think having a hedge in 2026 makes sense. And I didn't say this for the past couple of years because I didn't think having a hedge in 23, 24, 25 made a lot of sense because there was just so much momentum to the upside and the earnings growth was so strong. And companies were still, you don't need a hedge when Robinhood's at $8. You need to be buying calls when Robinhood's at $8. You need to be leveraging up and taking advantage of that bull market. And a lot of us did. But now that Robinhood's $130 billion market cap, does Robinhood go to $250 next year? It's very hard to see that. And if it does, I'm happy. But if it doesn't, I think having a hedge is not the worst idea in the world. Literally, the title of this podcast, and I'll link it in the chat for anyone who wants to hear it, is "There's No Place to Hide in Stocks." I'm listening to this as I'm driving back home yesterday, and I'm like, goodness, this guy is just straight up. Anyone who's listening to this that does not have their own original form of thinking, if you just think, oh, NYU professor, this guy's smart, I need to listen to him, you're probably selling everything you have on Monday. That's how intense the discussion was from a bearish perspective. And so I think a hedge is reasonable. I don't think getting out of the markets makes the most sense. But, we'll get a lot of data over the next coming weeks, and we'll try to understand a lot more to see what happens. That's what we got. That's what we got in the future show. I'll answer some questions and we'll talk about this Bill Ackman thing that was absolutely hilarious. My response to it kind of went viral as well. Even though, as soon as I saw his post, I was like, I know exactly what to say. And I knew his post would go viral, so I had to respond to it. But that's pretty much it. I think the game plan for this week is what data do we get from the BLS? Can markets stabilize? And can we not violate the lows that we had last week, 663 on the S&P 500? What happens to Google as the S&P 500 now is going to get a bit of a surge tomorrow, or potentially get a bit of a surge if Google holds on to this momentum. And if, potentially Google touches 300, Google right here up 6%. Again, 6% on a $3.3 trillion company is a very big move. So that's going to have a big move across the entire market if that holds itself. And then number 4, NVIDIA earnings. I'll be live with Jose, 3:30 p.m. Eastern on Wednesday. That is going to be a massive, massive quarter. Honestly, as someone who made NVIDIA one of my top 3 positions this year, I have zero anxiety going into this earnings because I think they're going to absolutely demolish the quarter. Like, I really don't think this is going to be a quarter where people need to be scared. I'm more concerned about the labor market data. Because, yeah, I think could NVIDIA, end the year at around 210, 220? I think that's possible. I think it's probably going to be there around that 195, 205 range, and that's bullish. More conservatively, probably in the 180s to 190 range. But none of it matters if we are starting to see a deterioration in the labor market. So I think NVIDIA will be fine. Every equity analyst report I've read has said NVIDIA is going to have a blowout quarter, and even without China, they're going to increase guidance. And you're seeing it through Jensen with a $500 billion 5-quarter opportunity that I talked about at GCC. Question becomes the macro data, and the labor market stuff is going to be very, very important. So that's what we got going into this this quarter. We are not doing a 24-hour stream, not today. Eventually, dude. Eventually, we'll do a 24-hour stream. I just got to figure out how to execute a 24-hour stream. Like, I want to have guests over. I want to make it fun. And yeah, right now I got to think about how we do that, but hopefully before the end of the year. Hopefully before the end of the year. Okay, so what the heck did? All right, so now that's done with the future show. We'll stay on for like another 20 minutes and discuss some of the other fun stuff we got going on. But this tweet, I mean, you guys have tweeted like a billion, or said it a billion times in the comments. This tweet was one of the best tweets I've ever seen. So for those that didn't see the news, Bill Ackman, wealthy billionaire hedge fund manager. I hear from many young men that they find it difficult to meet young women in a public setting. In other words, the online culture has destroyed the ability to spontaneously meet strangers. As such, I thought I would share a few words that I used in my youth to meet someone that I found compelling. I would ask, "May I meet you?" before engaging further in a conversation. I almost never got a no. It inevitably enabled the opportunity for a further conversation. I met a lot of really interesting people this way. I think the combination of proper grammar and politeness was the key to its effectiveness. You might give it a try. And yes, I think it should work for women seeking men as well as same-sex interactions. Just 2 cents from an older, happily married guy concerned about our next generation's happiness and population replacement rates. Look, I don't know if you go up to a girl at a bar and say, "May I meet you?" if that's your ticket to interacting with her a little more. Maybe it is. Maybe that's actually effective. But the amount of tweets over the weekend that have been going viral, and Bill Ackman's loving this. I mean, he retweeted this. I mean, this was hilarious. You have all these people tweeting out their Hinge conversations. There's just guys spamming "May I meet you?" to a ton of different girls. And some of the girls actually know about Bill Ackman. So they're like, "Oh, you're a Bill Ackman fan." Like, it's actually the funniest shit ever. And I mean, maybe it works. Now, what did I post under it? I posted, I just show them my Palantir and hood position, and then it's pretty easy from there. That's what I said. I don't actually do this. People actually thought it was serious, but it's obviously a joke. Like, I don't whip out my portfolio and be like, "Hey, look at," like, no, that doesn't happen. But like, I thought it was kind of funny. And like, so that was my response to it. But no, I just thought it was hilarious, dude. "May I meet you?" Like, really? Like, it's the funniest thing ever. And then you have this guy. I mean, look at these videos over the weekend from him testing this idea.
Attention, ladies of New York City. May I meet you? Bill Ackman just tweeted that simply uttering those words would result in women approaching me, especially on moving trains like this. Should there be a line that forms, please line up single file. Once again, may I meet you?
It's hilarious, dude. Like, it's actually freaking hilarious.
Hi, excuse me. May I meet you? May I meet you? Later. Bill Ackman.
She said later. I'm going to just pause it because the music might end up copywriting the stream. But she said later. And then he's like, "Okay, I'll meet you later." And he just stands there for 20 seconds. I mean, this shit is hilarious, dude. May I meet you? That is the argument. And then he tweeted this just now. He said, feedback from the field, a Stanford undergrad. I tried May I Meet You at a bar last night and it worked wonders. I have a date this Friday. Might be the thing that works. It might be the thing that works. So, by the way, Bill Ackman sold about 10% of his Google position as well. He was one of the only super investors that bought Google heavy back in the 90s. So, yeah, he did sell a little bit of his Google, but Buffett and Berkshire ended up buying. So, May I Meet You? That is the new meme. If you see that around over the next coming weeks, just notes from Bill Ackman. And I think it's hilarious. And maybe it ends up working for a lot of people. But, you know, he is speaking to something that we are having a broader issue in society, which is this idea of very less social interaction. I mean, if you look at the charts on the, first of all, the most obvious chart on this is population collapse. I mean, even it's not just in Japan, in the United States as well, like just not having as many people interact with each other anymore. I mean, it got to the point where Scott Galloway, who I don't agree with him on everything, but he has been talking about this loneliness epidemic a decent amount. And his argument was you should be okay with ruining your liver and getting drunk in order to meet somebody and have social interaction, because that is what you need to actually, you know, not be lonely. Here's what he said over the weekend.
Thing I love that you said in the book to men, drink more, because safetyism has, you know, this is one of the problems I have with certain people who make everything about safety. Safety is important. You can't overdo drinking. It is also, as you point out, a lubricant to get to that place where you are talking to other people and socializing. It's not to excess, but yes, it's social. Drinking a little bit, maybe sometimes a little too much when you're adolescent, is probably better than sitting in that basement.
The second worst thing to happen to young people is remote work. 1 in 3 relationships begin at work. This is where you find friends, mentors, and mates, and especially young men need the guardrails of a workplace. But in my view, the worst thing that's happened to young people is the anti-alcohol movement. I've had Huberman on, who I'm a big fan of, and Attia on, and my point is that the risks to your 25-year-old liver are dwarfed by the risk of social isolation. In sum, think of all the amazing relationships you've had in your life and be honest. Did alcohol play a role? In sum, get out, drink more, and make a series of bad decisions that might pay off.
Yes.
I don't know if I fully agree with that. I don't think you have to be drunk to meet people. Yeah, mocktails do the job. Mocktails do the job from personal experience, I can tell. But his broader argument is just social isolation is a big deal. And so that's why you have Bill Ackman tweeting about this stuff, because, you know, a lot of the older folks are recognizing how hard it is for younger people to meet. And as a result, you know, they are encouraging people to just go up and talk more with each other, which I think is not horrible advice. I don't know if you have to be drunk to do that, but nonetheless, that's one of the arguments that's taking place. By the way, speaking of people meeting up and social interaction, I am working on the New York City meetup, and I should have an update for you guys in about 2 weeks, and we will be officially starting to promote it, I think, first week of December. And we're aiming for, don't hold me to this date, don't hold me to it, but we're aiming for January 25th. It'll be a Sunday, January 25th. So LA meetup will happen. We're going to do the LA meetup. Singapore meetup's going to happen, but we're doing New York first, starting off in January. And I think it's going to be really cool. And there's going to be a lot of different ideas we have. And I'm working with a team to actually finalize it and make it real. There will be a ticket, so you will have to pay a ticket. The reason for the ticket is, number one, we're renting out a venue, and venues on average are about $10,000 to $12,000. So that's the first thing. Number two, we are hiring a shit ton of security. So that's another reason why we have to charge for a ticket, because we are making sure that this is as safe as an event as it can become. And number three, you're going to get food. So there will be a ticket. I think the max price of the ticket is going to be $100. So it's not going to be something too intense, but this is not $100 where there's like a 40% profit margin here. This is actual expenses that we are now incurring on starting these meetups. And the reason for these expenses, again, when I started this back in January, it was like calling up a local bar and like saying, hey, can a bunch of people come over? And they have like no idea what, they're like, sure, if they're going to buy drinks. It was very informal. And after Miami, there's like 350 people there. I was like, okay, we got to formalize this a lot more if we're going to, have that many people. So there will be a ticket price, but I do think the ticket will be well worth it. And this is not a ticket that leads to a ton of profit for me as an individual. Now, maybe in the future, if we start selling out like 5,000 people arenas and we do live shows, like that's going to be a lot more profitable if that ever does happen. But right now we're going to be running this basically at cost, and food, security, and venue are our biggest 3 costs. And it's expensive. With the team I've been working with, we looked at a lot of it. We think we have New York confirmed. It's a really nice spot. I don't want to say the name of the location yet, but it's going to be like 15 grand just to have like 6-7 hours of the place. And we're trying to negotiate another 2 hours, right? So like this stuff's expensive at the end of the day if you're booking venues, but it's worth it for the experience. Just, I think if you've been to the meetup over the past 5 meetups we've done, it really is worth it. So we're going to try to make it a good deal for everybody. So it should be fun. But New York, definitely in January. I don't know what February looks like. I want to say LA in February, but we haven't done that much thinking of the second meetup. But definitely LA is going to happen. We did the Bay Area last time, so we got to do SoCal. And then, did I say 6-7 again somehow? Did I really say 6-7 again sometimes? And then Singapore is the international one, and then obviously the UK. Those are like really, really important venues that we want to do. But we're trying to just get through the first one. And this is a new team I'm working with, so we have a really good vibes. We've been having meetings every Saturday, and again, I told you about this girl who started her own management agency, and I met her through one of the guys in Miami, and it looks like she's going to be coming on full time to work with me. But dude, she's just an animal. Like the fact that she has a venue. I mean, she had to run through a lot of different venues to like find the one spot. But like the fact that she found it and she's like, they are ready to go. We just need a deposit. I'm like, wow. Because like I know how hard it was to search for venues when I was doing the meetups by myself. And I got lucky a good chunk of times. The Boston one was the hardest one to plan. New York ended up being relatively lucky after the second bar, because the first bar was too small, but then we all walked to the second bar and we literally just winged it. And then California, I got lucky because I knew the bar owner, but it's not easy getting a venue. And quite frankly, you just got to be able to pay up to like book these spots. But, if you can formalize it, then it can be done in a decent way. I will meet you all at these meetups. She's not a dentist. She's not a freaking dentist. Dude, may I meet you is going to be the catchphrase of 2026. I really do think that. Like the amount of times people are just going to say that randomly. Nebby's right there up 5%, Google up 6.5. The meetups, everyone's going to be saying, may I meet you? It'll be hilarious. Yeah, see, look, are you going to call these meetups meetups or may I admit you? It's hilarious. But I'm excited for them. I think it'll be fun. I think $100 is relatively cheap. Again, we're doing them at cost. There's really not a margin here. And I think we're going to cap it at 300 people because the cost to throw on the event is around about 30,000, 300 times 100. So also I think above 300, like Miami just became really intense. So I think 300 is going to be the most. But if people are thinking of making a trip to New York, if you're flying in or you want to make a weekend out of it, January 25th, that is the tentative date. Do not buy your ticket yet until I give the official date, which will probably happen early December. But I think it'll be fun. Now, look, if we end up getting into a bear market, this is one of the questions I was talking about with the team that's planning this is like, do we still think there's demand for a meetup in a bear market? And I think there is, right? Like even if the markets are down, I think that sense of community is still really important regardless, right? So like, yeah, the sentiment's not going to be as optimistic if we're in a bear market, but the necessity for community and being able to still talk with people about investing, I think is still very real. In fact, you might need more people or more levels of community in a bear market. So I hope 2026 is not bearish, but even if it goes bearish, I think the meetup still should have demand just because all of us still want to meet in the midst of markets going up or down. People will buy more drinks. Yes, exactly. But yeah, New York should be fun. Should be exciting. And I think it'll be cool. The May I Meet Up 2026. Dude, I need to use this May I Meet You line. Like this thing is hilarious. Like it's absolutely incredible. I was literally reading. I read the tweet that Bill Ackman had 2 minutes after he posted it. It popped up, and immediately I was like, I have to comment under this. I was like, this tweet is going to go viral. Like you just know sometimes as a content creator that a tweet's going to hit. This tweet has 16 million views. Boy, is it hitting. Especially because one side of the aisle is like, this is so stupid. You go up to a girl and say, may I meet you? She's going to laugh at you. And the other side of it's like, well, maybe it's just like cringe enough to work. Like maybe it's just like, instead of, hey, can I buy you a drink? It's like, hey, may I meet you? Like, it's so like, it almost gets a sort of a humorous reaction that it ends up turning into a conversation, and then boom, you get into it. So I think that was relatively hilarious. Nvidia is the only one that has earnings this week. I mean, there are some other companies, but Nvidia is the main one. We have, well, actually, no, you have more. So you have Home Depot, Baidu on Tuesday. Tomorrow you have Xpeng, that Chinese company with robots and cars. And then on the 19th, you have Nvidia and Palo Alto after hours. In the morning, you have Lowe's, TJX, Target, and then Williams-Sonoma. And then Thursday, you have Walmart before the market open, and then you have Webull into it after hours. So Nvidia is obviously the big one, but you do have some other earnings. Siege, thanks for the super chat. I've got to be hammered drunk just to share my pickup lines with you, maybe at the next meetup. Oh my gosh, Siege, I hope to see you in New York if you can make it. It'll be fun. I'm going to try to get some of the mods out there as well. So a lot of the mods you guys know in the chat, like Doug and Tess and all these folks, I'm going to try to see if we can budget getting them out because, again, I said in Miami, it was just so awesome having them there. And like Matt Money, like just having people that you guys know in the community. Hopefully we can get Steve to come. If Steve comes, if Steve shows up to this event, oh my God, I don't know if we're going to have enough ticket supply once I say Steve's coming. But I'm going to try to get those people out to the event as well and make sure that they're there because, you know, it's just more fun when you have a lot more of the community there. So that will be the goal for the New York meetup, and we're going to see if we can make it happen. Tess will be at the D-Wave conference. Wow, they're doing a conference in January? Okay, so, all right, Tess might not make this one, but we have like 10, 15 mods, so we'll try to see if at least like 4 or 5 of them can come to each meetup, and we can get people there. Get a milk sponsor. Yeah, we got to get Ronnie Brook Farms to sponsor this shit. Dude, I can just imagine Steve and like 50 people like crowding him, just like wanting to talk to him. Like that, Steve will be like the star of the show. Absolutely will be the star of the show. Like I know everyone's just going to want to meet him. Nebius needs to pump to 100 so I can sell and buy your ticket. Yeah, dude, I really don't want to charge for this, but after like actually talking with a team of people, there's no way I can get away with not charging. I mean, the first 5 meetups we didn't charge anything, but when you're renting out a venue, like, and you want security, and like, you know, I think security is a very important thing just to make sure that everything's good, and you know, you have things that, in case anything were to happen, you have people there. Like those are expenses that are just like necessary, and so it's hard to eat the bill on like 30 grand. But you know, if 300 people pay $100, I don't think it's the biggest thing in the world. And you know, it gives us the scale to be able to do this across the world. So I think it'll be fun. Ahmed, how old are you? I am 28 years old. Not being able to buy Netflix on Robinhood right now must be getting ready for the split. Yeah, the split happens tomorrow, so more likely than not, you're not going to be able to buy this one. Oh my goodness, dude. We should get a cow. Yeah, Netflix is unavailable to trade on Robinhood. We need a cow. We need like a inflatable cow to be there if Steve comes. It'll be hilarious. Yeah, we need, instead of a bar, we need a dairy counter. Exactly. Yes, Chris, of course, will be. The problem with Chris is that he's in Georgia, right? And he works. So I'm going to try to get Chris out there. It'd be fun. Chris has not been to a meetup yet. He was supposed to go to the Miami one, but then he had a wedding that he had to go to. So it'd be very fun if we can get Chris and all the boys out there. We did Toronto last year. We'll see if we can do it again. Toronto was fun. I enjoyed it. But, you know, now look, again, Toronto, I did in a guy's basement in a luxury apartment building, like through connections from the chat. Like we like absolutely like winging it for those meetups, the first 5 ones we did. And they all went great. But I'm like, legit, we were like buying pizza near near his apartment for food for people. You know, it's just like full on, like bottoms up, like just, you know, winging it. And now I think institutionalizing and formalizing the process just makes so much more sense, especially if, you know, if you want to do it in a more profound way. So I think it'll be fun, but it'll be exciting to get on this venture for next year. Mid, do your neighbors hate you because they hear you talking for a camera for 7 hours a day? I don't think so. I think the walls are relatively soundproof. I've never gotten a complaint for ringing the bell or talking. So no, I don't think they care. Maybe they do, but they just live with it. That's what we got to do every morning and afternoon. This is what we do. Steve had an absolute crazy rant against Apple today. I mean, you know, quite frankly, for anyone who's watched the old debates with Steve and I over the past like year, I mean, I've been making the argument that Apple is kind of ridiculous in terms of their innovation. And I think something he saw over the weekend really got him pissed off. I think Tevis showed him the thing we talked about on Friday. And it's forced him to write a freaking article about how mad he is. He saw this, the iPhone Pocket, basically a fanny pack for your iPhone. He just went scorched earth on Apple. And it's like, look, but by the way, during this entire debate that we've been having for the past year, Apple has not done horrible. Like Apple's not obviously done as well as like Nvda or something, but it's not done horrible. So if you own the stock, you've been okay. But just like the anger of investors that this is what they're doing. By the way, Tim Cook's about to step down. The Wall Street Journal reported on Friday that it looks like he's getting ready to step down early 2026. But this shit, come on, bro. Like really, they're charging $229 for this shit. And Steve said if I ever wear this in front of him, he's going to like throw my iPhone away. So obviously I need to buy one of these and wear it next time I see him. We got to do it for the jokes, but it is weird, dude. It's a sock. Yeah, it's a sock for your iPhone. He finally admitted today too that the Vision Pro is a failure. I got a lot of shit in 2023. As soon as it came out, I was like, that shit's a failure. I was like, nope, it's not going to work. I know I'm biased because I don't like the AI glasses argument. Yes, I know I wear glasses. That doesn't mean I have to love the whole concept of AI glasses. I really don't think that thing's going to work out. For Meta, Apple, I think all of that shit is just not real. I don't think people are going to wear AI glasses and like communicate with seeing stuff on their screen. I just don't think it's going to happen. And I remember the narrative in 2023 was that's the next thing. And I was like, no, it can't be the next thing, dude. It just can't. No one's going to wear that shit on their face. Like, it's just like for extended, everyone who's bought it, it's like it's collecting dust now. I was even thinking of buying it, dude. I was thinking of spending $3,500, and I was like, dude, am I ever going to really use this? And it's like, no. Yeah, on Finance Junkies, me and Carlos got into so many debates about this, and Carlos ended up buying it. And I remember 2 weeks later, I saw it in the back of his screen. I was like, Carlos, have you used it in the past 2 weeks? He was like, no, but I was like, come on, bro. Like, it's a dud. We know it's a dud. Vitaly says he still uses his. I mean, maybe he does. Now, for gaming, I think there's a use case, right? That for the Quest. I mean, I know Vitaly's kids love using it for their games as well. When I went over to his house, his kids like were just obsessed with that thing. But I think if you're not a kid and you're not using for gaming, there's no use case. So I really don't know if it's going to be like the next big thing. Now, granted, if anyone can make it a thing, I think it would be Apple. I don't think it's Meta, quite frankly, but it's going to be up to Tim Cook's successor to figure that out. So I think that's what we got going on. Do we have any other headlines? I don't think we have anything else too crazy. I'm just hoping, dude, I'm just like the amount of emotions we all had to deal with last week. It was just so annoying back and forth. So much shit that the markets put us through. And, you know, it's the shit you have to deal with, but I really do hope this end of year rally is possible. The one saving grace is, first of all, Nvda is going to have good earnings, so I'm not afraid about Nvda. It's the labor market data being bad, which will end up being good for the rate cut. And that potentially is going to be the hay in the needle stack. Because what that's going to do is that's going to say, okay, labor market's not good, so we can cut rates, which is good for equity prices. But then if the labor market ends up becoming not that bad in 26, which I'm just hoping for, I don't know if that's going to be the case, then you're going to have equity prices stabilize. You're going to have rate cuts that are going to be more bullish. Jay Powell's going to leave in May. You're going to have a lot more rate cuts then. And if we have some level of healthy GDP growth, then I think 2026 will be okay. The other freaking thing we have to deal with is this stupid shutdown is going to happen again on January 30th, which is another reason I'm thinking like having some hedges going into 2026 is not crazy, because that first month, first of all, people already sell stuff in January historically because people don't want to take profits in December because then it ends up being shown on their taxes for the next year. So you have that as a natural sell-off that'll happen. And then if the shutdown nonsense happens again and we can't agree on healthcare in this country, I mean, who knows if it lasts more than 40 days. So I think there are two very obvious things in January that could be bearish, but hopefully that doesn't stop the end of your run, if there is one. Yes, it is hay in the needle stack. You guys have been served corporate propaganda over years, hearing needle in the haystack. First of all, it's harder to find. Just think about it logically, guys. Like 2 + 2 = 4, right? It is harder to find a piece of hay in a needle stack versus a needle in a haystack. So theoretically, like the metaphor makes sense. And I don't understand why people think that the metaphor doesn't make sense. I don't know what to tell you guys. That's what it is. It'd be simple to see a piece of hay in a stack of needles. Oh my gosh. Mathematically, he's right. Yes, exactly. What did you guys vote for, red or green tomorrow? What did you guys vote? Do you guys hear the sirens, bro? There are so many police every day. There was one, I'm not making an excuse for myself, but one time I was about to go live and it was like 8:45. Or I don't know, it was 3:45 as the market closed. And I waited till 3:47 because the sirens were going off for 2 minutes. And I knew that you wouldn't even be able to like really hear me speak. And so I ended up taking the shots for being late, but like the sirens are ridiculous here sometimes. I feel like I'm living in New York sometimes. What did you guys say? 68% green. Okay, 60. They're looking for Tom Lee. Oh my gosh, 68% green. Dude, I like it. Look, at the end of the day, this is the game, right? In content creation, the finance space, ultimately you put out your thoughts, your ideas, and hopefully you're more right than wrong, right? And that's how you develop an audience over the long term. And if you don't really necessarily take positions or like have opinions, then you can still be good at presenting ideas. But at the end of the day, I think you have to have an opinion, right? Otherwise, like, what's the point of like you got to have some level of perspective on the markets. And unfortunately, BM&R is down 50%. And a lot of people bought that thing around 50 to 60. Now, my adjusted cost basis is $35 on that thing. My actual cost basis is like 42. So my first entry was 49, but my like significant entry was 40 to 42. And that's how I got the average to get down. So then the question then becomes like, how down are the people that ended up buying it at that 160 crazy run that it had? There were tons of people that bought it that day, then 70, then 80. And then obviously it stayed at 50 and 60 for a long time. I didn't sell any at 50 or 60. I was very happy with the position. And, then the position ended up just completely getting hit. So the question now becomes, like, does it even recover by the end of the year? And this whole, 9,000 Ethereum by end of year, I mean, if it happens, I'll be very happy, but it seems very unlikely to happen. I mean, even getting this thing back up to 4,000 is going to be a challenge. And so undoubtedly, you're going to have people that are super pissed off at Tom because this is his stock. This is his thing that he's been talking about for a long time. And, it is what it is. Now, as a public figure, you have to be able to live with those shots and you have to be able to deal with the pain because that's how you make a name for yourself, right? A lot of people laughed at Tom Lee when he said buy Bitcoin at 5,000. But in the short term, ETH long term, I think will be good. In the short term, it's ugly. And in the short term, the internet's nasty, dude. The amount of nasty comments I've seen against Tom, like, it is what it is. And, and a lot of people, they tend to blame someone else when they make a purchase and that purchase ends up going against them. and they just need someone to blame. And I'm the same as well. Like it's always like nice to take shots at someone, and they're the reason you made a mistake, not yourself. But at the end of the day, like if I do it, it's more in a humorous way. At the end of the day, everyone needs to take responsibility on the things they buy, whether they go up or down. But Tom Lee has a cult. There's an absolute cult around that guy. So when he says something, people will do it. And unfortunately, a lot of people bought BMNR without having any idea what they were buying into for the long term. And quite frankly, even if they did have an idea, a stock getting chopped 50% in half in the freaking 2 months, it'll hurt anybody, and it'll make them upset. So time will tell to see what happens with Bitmine. I think long term ETH will be fine, but obviously short term it's ugly. And if the Fed doesn't cut rates, it's not going to help ETH or Bitcoin. And those are two things that we definitely need to see play out to help the broader argument. Thailand, third quarter GDP is up 1.2%. Okay, that's not too bad. Japan's was red, or Japan's was contracting GDP. But Thailand being up is not horrible. Why are institutions still buying? That's a good question. In fact, I forgot to show that chart. I wanted to show that right here, so thank you for that. Also, let me show you this chart right here. Gold is up 55% this year. Bitcoin is up 1%. We haven't seen this since 2013. So quite incredible to see the inverse between gold and Bitcoin. Now, in terms of institutions buying, I think the reason they're buying is because, well, two things. Number one, I think there's that kind of end of year chase that Tom's been talking about, as fund managers have to like be able to perform. But number two is because at the end of the day, they want exposure to the market. And, when you get Meta trading at 20 times earnings, you're going to get people that manage money that say, hey, it's time to buy. So take a look at this. Institutional investors bought U.S. equities in 60% of S&P 500 declines of at least negative 1% this year. This marks the first time since 2019 that institutional investors' percentage has exceeded 50 points. They have been dip buyers in 5 out of the last 18 years. This is one of those 5 years. Retail investors bought the dip each week this year after the S&P 500 declined over 1% every single week. This is the 6th consecutive year with their percentage above 50. Hedge funds have not exceeded this mark since 2019. So hedge funds have been selling. In fact, retail were net sellers 2 weeks ago. Institutional investors, which some institutional investors, a hedge fund can be an institution, but obviously hedge funds are more actively trading and managing and hedging. Institutional investors kind of have more of a strategic long-term strategy, right? They might go short, they might hedge, but they're generally more long. They're the ones that are buying. So I think it's not crazy that this rally has room to happen towards the end of the year, but you need those broader institutional investors to continue believing that the market deserves the premium that you're paying. Look, at the end of the day, we're paying 23 times for the S&P 500. I mean, historically, it's 17 to 18 times. So the question is, does the amount of earnings expansion and AI and margin, all that stuff, does that justify paying more for the S&P 500? And when you really think of it, like by first principles, I think the answer is yes, because from a first principles perspective, if the ROI on all of that is real, and we've seen that with earnings growth, it's not like that's fake. By the way, I wanted to play one clip for you guys as well from another fund manager called Gavin Baker. If we're seeing that, you can't necessarily say it's fake. The question is, to what extent does that increase in 26? And 2026 is still estimating double-digit earnings growth, which we would have for 2 years in a row if we actually end up doing that for 26. That to me is why you pay a higher premium. But the market has to ultimately think of that as well. I don't know why SoftBank's up 37%. They were up on Friday after hours. I don't know why this thing is up 37%. Like, I have no clue, but yeah, it is up. The SoftBank did sell their entire Nvidia stake. Yes, Peter Thiel also sold his Nvidia, for those that are asking. He bought Apple and Microsoft, sold Nvidia. And so does SoftBank. Someone said, Amit, have you ever shorted something you loved? I've never shorted a stock that I own. I do think in 2026, like, I have a big Nvidia position. Buying puts on Nvidia is not crazy. And that doesn't mean you're bearish Nvidia. That means you want to literally do what a put is supposed to do, is buy insurance for your position. So I'm actively thinking of whether it's through covered calls or puts, kind of how to hedge to some of the downside paid in 2026. But look, I think if you have a lot of money in a position, it's worth investing, because, like, if you have $1 million position and you take a $50,000 put position, like, instead of that million, getting hit badly, it'll still get hit. And given hopefully your average is reasonable enough, you're not going to be losing actual money. You'll just be losing paper gains. But if that could be hedged to an extent to offset some of the losses, not all the losses, unless you develop the trade in a certain type of way, then I don't think that's horrible, especially after 3 years of a just pure on run, right? All these stocks are not 2023 dirt cheap anymore. They've run for 3 years, all of them. And so if they were to take a breather in 26, it wouldn't surprise anybody. So I think having some puts there is not that crazy, especially on some of the more aggressive volatile names. Sachin, what's up? I see you in the chat. Bro, Sachin, your boy Tanner, he bought PayPal. You guys know Sachin is developing a pretty large PayPal position as well. Tanner, on Friday, he was on the show on the close, and he said that he's buying PayPal. I don't think it's crazy, dude. $62. They're buying back 10% of the company. Like, I haven't made a decision if I want to buy some, but I mean, you're talking about something that's safe in 26. Now, maybe PayPal's not safe. Maybe it's going to be crap in 26, but it's down 30% on the year. Like, is it really going to go down to $40 next? Like, at the end of the day, someone's got to step in, right? So I don't hate the trade. I do not hate the trade for PayPal. And, if it gets anywhere near that 55 level, I think it becomes very attractive. But the question also is the opportunity cost if we have a full-on bull run in 26 and then, which, by the way, there's a lot of people doubting that bull run in 26, which is also good because if that many people are doubting it, maybe you have a lot more walls of worry that allows us to run. I mean, again, the amount of freaking bubble conversation I heard over the weekend, it even shocked me, dude. Like, I know people were talking about bubble, but like, this is like becoming a legit, you're talking about news channels that don't even focus on stocks. They focus on politics and they're talking about the bubble. Like, it's almost an inevitable thing that we are in an AI bubble. And then, Steve had a great post on X last night. I'll link it right here. I recommend people reading it. Steve is pretty rational and he looks at the numbers. And when you go through all the numbers that he laid out in this post, it's like, where the hell do we see a bubble? Like, what are we talking about right there? It seems hard to say that it's a bubble. Here's another argument why it's not a bubble. Here's Gavin Baker, who was one of the investors back in the .com bubble. He now manages a fund. He was early Nvda, early Tesla. Here is his argument on why we might not easily be in a bubble.
Trailing earnings, Nvidia's at more like 40 times. So valuations are very different. Most important, however, Cisco peaked at 150 or 180 times trailing earnings. Nvidia's at more like 40 times. So valuations are very different. Most important, however, is that the year 2000 internet bubble or telecom bubble was defined by something called dark fiber. And if you're a veteran of the year 2000, you'll know what that was. But dark fiber was literally fiber that was laid down in the ground and not lit up. Fiber is useless unless you have the optics and switches and routers that you need on either side. So I vividly remember, companies like Level 3 or Global Crossing or WorldCom would come in and they say, we laid 200,000 miles of dark fiber this quarter. This is so amazing. The internet's going to be so big. We can't wait to light these up. At the peak of the bubble, 97% of the fiber that had been laid in America was dark. Contrast that with today. There are no dark GPUs. All you have to do is read any technical paper, and that one of the biggest problems in a trading run is that GPUs are melting. And this
was a really compelling point to me because every person you listen to, every earnings we see, there's not enough GPUs. I mean, Nvidia is literally pressuring TSMC to increase the wafer capacity by 50% because their month-over-month demand is exceeding the amount of supply that they have. So, I mean, there is a reasonable argument to say the .com bubble with all this dark fiber never ended up being used, which is what inevitably caused a lot more companies to crash. And I know there's more nuance to it, but that was a big part of it. In this part of a technological revolution, every GPU companies can get their hands on, they are using, which means there is a reason for why they're buying them in the first place.
A very simple way to kind of cut to the heart of all of this, it is the return on invested capital of the biggest spenders on GPUs, who are all public. And those companies, since they ramped up CapEx, have seen, call it a 10-point increase in their ROICs. So thus far, the ROI on all the spending has been really positive. It's an interesting and open debate about whether or not it will continue to be positive with the quantum of spend we're going to have on Blackwell. I personally think it will, but there's no debate that thus far the ROI on AI has been really positive, and valuation wise, we're just not in a bubble.
I couldn't agree more.
You got a lot of people that disagree, but I do think those arguments make sense. Figma's down 55% from its all-time high. How is that a bubble? Right? You got a lot of the like Figma's a great company, and I think if they fall another 10%, they actually become a lot more compelling valuation-wise. They're actually trading at $20 billion right now, which is what Adobe tried to buy them out for a couple of years. But Figma down 55%, that doesn't scream bubble to me. Oklo from 193 to 95. I mean, I think Oklo's still pretty expensive, but it's not like it's that 193 crazy $40 billion company with no revenue. So I just think the bubble argument is, I don't know. Obviously, we could all be wrong, and this could all be some gigantic Ponzi scheme that we're entering into. But it doesn't feel like that given the ROIC argument he talks about. The biggest indicator of what could inevitably be some collapse of a bubble, and I keep going back to this because, I think we cannot be ignorant to this, is OpenAI. If OpenAI isn't good for the 1.4 trillion that they've contracted for, I think a lot of these stocks are going to get hit pretty bad. And again, I love everyone who's in AMD, but the only reason AMD is up from 150, it has nothing to do with the earnings. It's the OpenAI deal. I mean, look at that chart when they announced the OpenAI deal and look at it before. If Sam Altman doesn't say, we're going to give Lisa Su $100 billion and then get 10% of the company at a $600 price, which implies $1 trillion, I don't think you have that stock really make a move. Now, the investor day, even without the OpenAI news, was really bullish. And I think AMD stock is probably up higher from 150 at the lows. But I don't know if it's pushing 250. And the comparable here is Oracle. Oracle freaking was 220, OpenAI deal 350. The problem is Oracle then said, hey, 40 billion of debt. Are we willing to buy? And the market was like, we are selling this stock so quick because we have no intentions to stick around for some bond defaults that are going to happen. AMD did not say we're going to issue 40 billion of debt after their stock price went up $100 billion in market cap. And so the markets, have been relatively calm, and obviously AMD is growing faster than Oracle. And, you could say that they're a more critical layer of the chip infrastructure, given they're actually selling the chips, not just selling the compute layer, which theoretically could be done by other players outside of Oracle. And that's why AMD kept its gains. But at its core, it's because of that OpenAI deal. Broadcom had a $50 billion deal, or I think it was a 5 to 7 gigawatt deal with OpenAI a couple weeks ago as well. So I think the biggest risk is OpenAI isn't good for the money, which means OpenAI doesn't end up growing. And that's why I think it's very important for all of us to keep an eye on OpenAI. Now, look, if OpenAI ends up failing, does that mean the LLM AI thing is over? No, because there will be other companies that take the role of that. But that $100 billion that Lisa Su was supposed to collect, that goes away. The $300 billion Larry Ellison was supposed to collect, that goes away. $70 billion Broadcom was supposed to collect, that goes away. And so I do think that OpenAI is going to be one of the most important companies of really the next couple of decades. And it's nice to see Brad Gerstner and Jensen and a lot of these people co-sign OpenAI. I would hope that Gerstner's not co-signing a bubble, or Jensen. There's a lot of very, very, very smart private investors that are in OpenAI. I mean, you would imagine that that company is going to be able to grow, but that to me is the larger risk, not that there's not an actual use case for AI. So that's going to be important. Lisa Su said to expect deals as big as the OpenAI deal on Analyst Day. Now, see, that's also important. I remember that Lisa Su said that, and it's good you're bringing up that quote, because if Lisa Su and Nvda and Broadcom can get a deal like that with Anthropic, for example, or even with Google, I mean, then you continue to validate. I think we've already validated the amount of CapEx spend that's happening. Again, I showed that chart of Elon and Sundar going back and forth. It's very real the way the smartest people in the world are talking about it. But if they can consign even more of those deals worth hundreds of billions of dollars for compute, first of all, super bullish for the Nebiuses, Irans, all those data center places, because there's going to be so many trillions in the system that are never going to flow to the core weaves of the world, even if they have to take on a lot of debt. But number two, it will validate that it's not just OpenAI that's spending these crazy trillions of dollars on compute. It's also Anthropic. It's also Meta with Llama. It's also Google with Gemini. I'd say it's also with maybe the Chinese companies, even if it's not in Nvidia and AMD, but in their own way, to be able to generate the infrastructure that's necessary for the amount of CapEx spend that we need. So more and more of these deals, I think, are going to be very important. The other stat I saw over the weekend was that GDP spend as a percentage of GDP as a percentage of capex over the past 3 years, 2.5 years, 50%. Meaning, if we didn't have this capex boom on AI, the U.S. would be in a recession by now because we would have negative quarters of GDP growth. Now, that's not controversial to say because obviously every time we have this massive stock market run, massive GDP run, you have a huge level of industrial investment. And with capex, you have data centers, electricity, construction, buildings, all this stuff. Like, it creates jobs, and there's a lot of different good things that happens because of it. But if we didn't have that over the past 3 years, there would be no real economic story other than maybe like 0.5% GDP growth quarter over quarter. So AI has been everything. As long as that continues, then that's going to be really important. When is the Singapore meetup? Likely in July. Likely in July. Again, I will give you guys more details over the coming months. New York, January 25th. Don't hold me to it. I will let you know officially in December. Likely the first week of December. But yeah, we are aiming for January 25th. It's going to be like a brunch. It's a really cool spot. So there will be food included. It'll be like a brunch, but it's a really dope location. Like you can see the entire Times Square from the view, and it's a dope spot. So once we finalize the location, I will put out all the details. Are we gonna do Chicago, baby? I gotta figure it out, dude. I know for sure London, Singapore, LA, and New York. Those, we have to do those 4 because I promised those 4. But the other ones we got to figure out. Hopefully we can do Chicago. It's going to be once a month. We're going to try to do once a month. So 12 for the year. Yes, there will be mimosas at brunch. It'll be fun. It'll be going. And so I'll get it finalized and let you guys know in a couple weeks. But yeah, we're making a website for it, all this stuff. We're just trying to really formalize it because, dude, I was managing this through Google Forms. It wasn't. I don't know how I managed them. There were people on the 2 days before that didn't get the location. I was like, how did you not get the location? I was like, and it was probably my fault because I didn't send it to them. So we really need some structure in this, but I think it'll be fun. I mean, why do you want to do NYC in the winter? Well, first of all, the first meetup, I want it to be easy to do. And the easiest thing to do is, where I'm closest to. So New York is what I'm closest to. Number 2, it's New York in the winter, dude. New York in the winter is great. New York in the winter is beautiful. Doug, you and Matt got to come see. I think Matt said he'd never seen Christmas in New York. Like, Christmas in New York is special. Got the tree going up. You got the lights. So that's why we got to do that. It does get cold, though. It does get cold. It's not a design agency. It's like it's not even an agency, dude. It's a girl who is leaving an agency that she worked at for 10 years, a talent agency. And I met her based on someone that I met in Miami that I became good friends with. And he's had a lot of experience in event planning for the past 40 years. So, he has a lot of hookups to security and all this stuff. So, I think it's a really good group of people. We're just trying to finalize everything. And her work ethic is crazy, dude. The shit she's done in the past 2 weeks, it's like, goodness, bro. It's a lot of work. I haven't even paid her yet. We haven't even signed a contract. So the fact that she's working so hard is quite incredible. But yeah, should be doing New York, and it'll be January. All right. Yes, well, Desi, we'll do Miami again for sure. It'll be a fun one. We'll definitely have to do Miami again. Hopefully, hopefully we should try to do Miami in March, so we don't have to freaking do it when it's super hot in August this time. But it'll be fun. All right, cool. So I think that's it. I'll see you guys in the morning. I hope this week is good and bullish. And we got Nvidia earnings. We got Trump tweeting about Epstein again. It's a long ass tweet. I'm not reading this. I'm literally looking at it on my screen. It's it looks like it's 15 sentences. But basically he's saying Epstein is a trap and don't trust the Democrats. That's what I'm getting from all these big words. So That's what you got. The Epstein stuff, I mean, we'll see how that plays out. There's going to be a vote, I think, next week or this week on releasing the Epstein files. So, I mean, I don't know how that's going to work, but that might also be something that we're going to have to keep an eye on. Oh, yes, let's spam Steve. Okay, we got to spam him. All right, so what do we spam Steve with? It's got to be something good. Amidst Grinder bio, may I meet you? See, I hate you guys. I absolutely hate you guys. I got to try this may I meet you thing, though. I'm kind of liking it. Kind of cool. Like, we got to try it. There's been a lot of girls, though, who have, like, commented on it, and they're like, if any guy ever says this to me, and I'm like, but I think there's something unique about may I meet you. There's something about it, dude. Like, imagine you find your wife by saying, may I meet you. Some guy tweeted at Bill Ackman. They were like, I said, can I meet you? And I got rejected. He was like, dude, you have to say may, not can. I was like, he's right. Desi says, I kind of like it. Dude, just like imagine going up to, I think you have to have a certain level of confidence in general when you go up to a stranger, whether you're a girl or a guy. But then if you have that level of confidence, then you hit it with a may I meet you. I don't know, dude. I think Ackman's onto something. I think Ackman is onto something. All right, what do we spam Steve with? What are they talking about?
Stream. When you add all of this up, I am telling everybody the amount of product that is going to be on the market in the future is going to be significantly less.
Okay, so they're talking about Pokemon. Do we do the Apple? Oh, may I meet you? Oh, that might be it. Or, okay, he's really pissed off about Apple. He's really pissed off about Apple. Apple to the moon? Apple 300, guys? May I meet you, I feel like it's fun, but it's not as fun as pissing him off about Apple. What about Apple's cheap? Is that enough? Apple's cheap? What do we think, bro? What do we think? We need a good one. Apple too cheap. I think Apple 350 or Apple 300. Apple with a I think just this. Oh, would rather buy Apple. Oh, no. Let's do that. Apple Pokemon with the greater than sign. Apple Pokemon. That's it. All right, that's the one. Apple Pokemon. Let's do it. That's the one. That'll get him good. That will get him good. There it is. That's the one. That's the one. That's what we got to do. All right. Let's see if he actually reacts to it quick enough.
Sports cards, I think it's TCG, not necessarily comic books, but these things I think are going to have a lot of staying power. What I'm seeing at the conventions and the shows is just a ton of liquidity, and the numbers just work.
Yeah, I mean, it's everything. I know, I love it.
Look at the chat, and you know this is all a myth. This is all a myth.
I love it, dude.
Because I went on a freaking Apple rant.
There he is. No, that's so funny.
Oh my God, with the stupid fucking pocket for the fucking iPhone, it annoys the shit out of me.
Dude, that's so
he's gonna buy one too. I know he's gonna buy one.
Of course I am.
You know, it's funny. Hey, I'm gonna make Amit very angry right now. I have never owned an iPhone in my life.
That won't make him angry.
Oh, I've actually never owned an iPhone, man. I've had Android since the beginning, basically.
Yeah, same with my wife. My wife has an Android. I have an iPhone.
But yeah, man, like all those different like
Apple over Pokemon, baby. I'm seeing Steve next week for dinner, so I think I got to get this this fanny pack or whatever. All right, guys, that's it. Thank you, everybody, for being here. Alexis, thank you for becoming a channel member. Appreciate you being here, man. And thank you all for continuing to be here every single day. We'll be back tomorrow morning. Substack's going to be posting a lot more. I have a lot of ideas for Substack. And so I'll have a post out tomorrow, not the deep dives, but kind of a deep dive on like an economic topic, not just the company. The company deep dives, I think, will be back next week, but we'll be having a lot more content on Substack this week. I've been planning a lot of stuff, been compiling a lot of data, and hopefully we'll be able to get some other perspectives out there as we get into the end of the year. So that's it. Thank you. But also, I mean, I'm just personal update, dude. I'm really killing it at the gym. Like I am really getting my vibe back in the gym. I've worked out 4 out of the past 7 days. I'm starting to like running again. If you guys were watching in 2023, I would burn 1,000 calories on the treadmill, like easy, like within less than an hour. I'm not back to that level yet, but when I was running yesterday, like it felt good. Like I wasn't like, dude, like even to burn 200 calories, run like a mile and a half a couple of weeks ago, it's just like I'm huffing and puffing. I can't get there. Yesterday, I was like, shit, dude, running 2 miles was like nothing. Like literally nothing. And so I'm feeling really good, just like health-wise. And I'm already seeing a reduction in weight, which is good, down about 4 pounds. A lot of that's water weight, but like, you know, just getting the weight off, I think is very, very important because like I should not be weighing what I weigh right now. And I think by end of year, and I think quite frankly, I'm going to be losing a lot more weight rather easily because there's so much excess weight. Like it's just naturally, you know, when you're that much bigger as you start working out, like, and you have a caloric deficit, it starts to come down. And, you know, when you see progress, it just motivates you to keep going. So very, very excited for that. I do think for anyone who has, you know, end of year goals, instead of waiting until 2026, I know it's super easy to be like, well, I'll focus on that in 2026. And I was thinking of that too, but like, dude, I've been saying that all year and it's like, you just got to fucking get to it. Got to just get to it. And I've been eating good too. I've been eating really good, dude. Like very good. Like no bullshit, no fast food, nothing like that. Making my own food. If I don't make my own food, it's something organic. So like I feel better, I'm eating better, drinking way more water, and working out. So I think it's really good to have all that as we, you know, focus on growing our net worths. That stuff is like really, really important because it's been 2 years, dude. It's been 2 years I've been letting my body go, and I've justified it through like I'm working hard, building a brand, which like sure, but at some point you gotta lock in. You gotta lock in. So, all right, let's go. Keep spamming Steve and piss him off, dude. Someone just said apple's better than oatmeal. Oh my gosh, dude. Now we can just do apple greater than anything. Apple greater than anything. All right, thank you, everybody. Love you all. I'll see you guys on the market open tomorrow. Bye, everybody. Have a good one.